Okay, guys, we're going to go ahead and get started. Before we pick up where we left off with Chapter 1, game plan for tonight is to complete Chapter 1, get a sense of the practice midterms, the way those are going to look. We'll see for Chapter 1, I actually embedded it in the slides for Chapter 1. And then I'm hoping we can get through most of Chapter 2, including the in-class example. We're going to walk through a little Excel spreadsheet to see how we would use something called journal entries to put together a set of financial statements. And then probably a little ambitious, but maybe even look at the quiz, not the quiz, but the practice midterm for Chapter 2. If not finishing that, maybe starting off on that and seeing how that'll look. Okay. So that's the game plan for tonight, but before we get into that, are there any general questions to start things off?
Hi, John. I have a question. I think we all know that the past week has been super rough on most of the people living in Bay Area due to the wildfire. I myself is in Santa Clara, and we're being told that if anything were to happen, since we're pretty close to San Jose, where some of the fire broke out, we are being told to be ready to go at any time. So in case that we are impacted sometime next week due to the wildfire, or if the school closes, what's the best way to let you know that obviously class is going to keep rolling, but what if we cannot physically or virtually attend your class? Like maybe we should set up a game plan to notify you before then?
Well, if the university closes, which it did for Wednesday, I had a class on Wednesday that I did not run via Zoom due to the class closing, then due to the campus closing, but it canceled all online and the very few online classes I think on-campus classes I think they have, then no class runs. If the university doesn't take the step of closing the class, I'll run the class, I'll record the class, and you'll be able to view the recording once you're in a safe location or in a place where you can view the lecture. So if the university closes, we'll cancel class just like we would if we were kicked off a campus because of a closing. If they don't close, then we'll run class at 6 o'clock on Tuesday. I'll record it in the event you can't attend. Because of that, yeah, shoot me an email letting me know that that's the case. And then the lecture itself will be there for you to watch at your, I never want to say convenience, but at a time, because I know it's never convenient to sit here and watch a lecture. But, at the time, yeah, your convenience at a time that works for you. Does that answer the question?
Yes, it did. Thank you for your response.
Yeah, sure. Okay, good. So let's just go ahead then. Any other questions? Okay, then I'm going to go ahead and just put up our slides for Chapter 1. Sorry, guys, you probably didn't need to see my email, but and my recollection was that we had stopped pretty much after the ethics slides, and we were getting ready to get into, really? Okay, here we go. We're going to get into the discussion a little bit more about financial statements. Okay, so just a quick review of the things that we said about financial statements. The primary statements that we're going to be focused on in this class is going to be the balance sheet, the income statement, the statement of stockholders' equity, which at first we'll call statement of retained earnings pretty much. And then statement of cash flows we'll get into towards the end. I think about chapter 12, we deal with that. Note disclosures. Every set of financial statements has a set of notes. Those notes are there to elaborate, provide additional information about just the numbers that we see on the financial statements. Financial statements would not be understandable, really, if all we did was have numbers for different assets and liabilities without further elaboration, explanation of what some of that information means. And so we always have a set of footnotes that go on and give different sets of information that will help make those financial statements, the numbers, more understandable. Sorry, guys, I never seem to realize that my classes, I can't see out of them until I start trying to run the class here. Okay. We talked about the opinion on the financial statements. So an independent auditor comes in, and even though management's responsible for the financial statements, the CPA is responsible for giving an opinion. That adds reliability to those financial statements because we know that a third party looked to see that those statements were prepared in accordance with generally accepted accounting principles. We'll pretty much refer to that as GAAP. In the United States, those standards are issued by the Financial Accounting Standards Board. We said that was a 7-member board that sets accounting standards for all companies in the US that have their stocks listed on the stock exchanges, but even private companies will follow FASB because maybe a bank or something that plans to give them a loan would want their statements prepared in accordance with the FASB, the US standards. Remember, we said that for public companies, we have the Security Exchange Commission, which is a federal government entity that has basically delegated its authority to set accounting standards to the FASB. And so they have a watchful eye there, and they weigh in with various requirements now and again for public companies that maybe go beyond some of the things that FASB requires. But for the most part, we're going to be focusing right here on these standards, how those standards play into the preparation of the financial statements following general accepted accounting principles. Now, there's not a whole lot in this class, though, that really gets deeply into some of the nuances of these standards. What we're more concerned with in this class, remember we said last time, are the basic building blocks, the basic procedures that are used throughout, frankly, the world, and frankly, since the 12th century, that have been used to prepare financial statements. And we're literally going to start to get into that really when we get into chapter 2 here. Okay, so that's just sort of a quick synopsis of some of the things we said last time. But remember our users, we say various users. Our primary users were what? Investors and creditors were our primary users, right? There's also secondary users such as government entities like the IRS, but they're not primary users. And when FASB puts together a set of standards, they're thinking about investors and creditors as their primary users. Okay. Any question on any of that? Okay, good. So with that, let's go ahead and take a look at some very basic, simple financial statements. Now remember, last time I kind of went through and quickly showed you what Apple statements look like, and those were just kind of horrendous numbers and giant amounts of revenues and expenses and whatnot. So we're going to bring it back down to a simpler, basic example of a set of financial statements. And the first statement that an entity will prepare is the income statement. Okay, when you have the income statement, just like we saw when we looked quickly at Apple the other day, we have revenues, we have expenses. The difference between revenue and expenses is called net income. So you take your revenue minus your expenses that you incurred to generate that revenue. Difference is net income. The second statement that any company will prepare will be the statement of retained earnings. I know we said statement of stockholders' equity when we were looking at that previous slide, but for right now, statement of retained earnings is a component of the statement of stockholders' equity. But for right now, let's just think about statement of retained earnings. And this company started operations this year. How do I know? Because they're beginning retained earnings, or I guess started this company September 1st. How do I know that? I know that because their beginning retained earnings is zero. So they've never had net income before. Now, what I like to do is just have a silly little picture here. And anyone that can figure out what this is first, I'll buy you a Coke someday if I ever see you in person. Okay. What is this? This creature I just drew on here.
Is it piggy bank? Pig?
Good. Yeah, it's a pig, and this is a piggy bank. Excellent. See what a genius artist I am? Okay. So what happens? We sit here and we have our piggy bank, and where do you put your net income, right? You have a job, you have to spend some money to get to work and whatnot, and you end up with what? You end up with something left over. You put it into your piggy bank, right? So our retained earnings is like our piggy bank, but what do you do every now and then? Every now and then, okay, and I'm not trying to put that in a crude place, but you pull what? You pull the stopper out of that piggy bank and you take some money out every now and then. Now you take that money out every now and then to go buy something that you as a human being like, for example, hamburgers or, you know, ice cream or whatever it is that you want to buy. And so you periodically will pull some money out. Well, when a corporation pulls money out of a piggy bank, they are typically dividing that, distributing that to their shareholders. We call that a dividend, right? So we have a corporation, they generate some revenue, they have some expenses. Remember, corporation is a separate legal entity from the owners, but we put our net income into the piggy bank for the corporation. But every now and then, the owners are going to sit here and say, hey, I need some money here. I need some money to pay the separate legal entity, the human being. When that happens, that is called a dividend. That dividend comes out of the piggy bank, out of retained earnings, and then we're left with the ending balance here, which you see, I kind of drew over a little bit. You see here is this 1450. Okay. Question. Okay, good. We call that money that comes out of the piggy bank a dividend. And then we third prepare our balance sheet. This is just a repeat of our statement of retained earnings. We third prepare our balance sheet. Why do they call it a balance sheet? Because it balances, okay? Because what? Because my total liabilities and stockholders equity is going to balance with my total assets. So assets will always equal liabilities plus stockholders equity. That's why they call it a balance sheet. Okay, so we have these assets up here. We're going to talk more about assets and liabilities in a couple minutes here, but assets are things like cash, buildings, things that have future economic benefits. Liabilities are our bills, and then if there's anything left over after you've paid off all your bills, you have your stockholders equity. Stockholders equity, at least in the beginning of this class, is really just going to be common stock and retained earnings. Retained earnings is our piggy bank. And you see that we take the ending balance of retained earnings at the end of the period, we roll that down to our balance sheet to show our retained earnings and the balance sheet balances. Okay. Now that's just a very, 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 high level look at how these financial reports will look, okay, and how the different pieces of them relate to each other. Okay, this is the statement of cash flows, guys. We're not going to get into this in sub-mention until much later. Way back about chapter 12, we'll get into this. All right. Any quick question on that?
So for, I guess, dividends, is that like a catch-all bucket for cash expenditures?
No.
Okay.
It's nowhere near that, okay?
Yeah.
Expenses are when we have an asset and a future economic benefit expires, we call that expense. And we match that with our revenues. Okay, so any costs, expired costs that we incur to generate revenue, we call those expenses. We match them with the revenues and generation net income. As I said, net income goes into the retained earnings. Dividends are a payment out to the owners, shareholders in a corporation. Could be an amount that gets paid out to an individual owner. Maybe I hold all the stock of the company, right? But I want to pull that out of the corporate accounts. And so it typically is a cash dividend. It's money that's pulled out by the owners. So now the owners can go buy hamburgers or things that human beings like. Corporations don't eat hamburgers, right? Human beings do. So human beings need to pull some cash out of that corporation. It's typically cash, doesn't have to be, could be a property dividend that's paid out, but it's assets that are paid out from the company, typically cash, to the owners, and the owners pull that money out, go do whatever it is owners do with that money. Their own private business. When I say their own private business, their own private lives, whatever they do with that money. And then the whatever's left over, of course, is the ending balance. So it's beginning balance plus net income minus dividends gives me the ending balance.
Thanks.
Okay. All right. So what I want to do, let's look at a couple questions, I guess. I might ask you something like this on the midterm. Not really, though. When we combine activities of two different companies, that would violate the economic entity assumption, right? We keep the what? We keep the activities of the owners separate from the activities of the company itself under the economic entity assumption. And of course, you would keep what? The economic activity of two different entities, you would keep that separate. So economic entity assumption, we prepare financial statements that reflect the financial activity of just that one economic entity. How about this one? A business organization organized under separate legal entity under state law, having ownership divided into shares of stock. Not the most difficult question I think you've ever dealt with. Obviously, it's a corporation, right? Okay. Okay, good. So let's look at this as we saw on the balance sheet. Now, assets equal liabilities plus stockholders equity. And this will always balance, okay? If this equation does not balance in the accounting world, nobody goes home until this balances. It means there's a mistake. You do not have this equation not balancing. It will always balance. And we're going to look at a system here a little later when we get into chapter 2 that will ensure, well, I shouldn't say that it'll ensure because someone could make an error in how they're applying the system, but this system is intended to make sure that this equation always balances. This will always balance. Assets equal liabilities plus stockholders equity, okay? Now, assets have future economic benefit. Assets have future economic benefit. So is cash an asset? I think everybody realizes that cash is an asset. If you don't think cash has future economic benefit, go ahead and give me your cash right now. And you'll say, whoa, hang on a minute there, buddy. Okay, because you're sitting there saying, hey, I've got future economic benefit. I can buy a house with this. I can buy my lunch with this, my dinner, a car. So cash has future economic benefit. Good. Does a building have future economic benefit? Yes, it does. You can run your business out of that. So a building is an asset. Does a vehicle have future economic benefit? Yes, it does. So a vehicle is an asset. So anything that has future economic benefit is considered an asset. Now,
what about the loan on your vehicle? Is that just separate that we consider a liability? Because I lump them together in my own life.
No, your liabilities are your bills. Think of your liabilities as your bills, liability, and I'm saying it kind of funky like that just so we're seeing the bill aspect there, okay? So your liabilities are your bills. They are your claims against your asset. So if you have a car note, you know, against your car, then you would list that as a liability. You just don't say car minus the note and that's what you put down as car. You would have to list that out separately as a liability, okay? So let's just think about this for a second. Let's say you have $100 in your pocket, but in your other pocket, you have a $40 cell phone bill, okay? Well, that $100 is not all your future economic benefit. $40 of that, what? Belongs to the cell phone company. So when you prepare your balance sheet, you'd say, well, yeah, I have $100 cash, but I have a bill. I'm getting ready to send $40 of that out to the phone company. So really, I only have owner's equity, stockholders equity, and what? $60 of that $100 cash. So you report your claims, your liabilities, your bills are your claims against your assets. You report those in the separate section. Remember, we saw on that balance sheet, the liabilities were down there with the stockholders equity, so that then users of the financial statements can see, okay, there's really only $60 worth of equity here that is still, you know, there still is not a claim against those assets. Question?
So if I had a business with a vehicle and I still owed money on the vehicle, but the vehicle itself is also an asset, then how do I, you know, and that's my entire business, then how does that balance?
Well, if the asset equaled $100 and the note that you still owed on the car equaled $40, you'd say asset, car, $100, liability, note on car, 40, owner's equity, 60.
Okay, and I'm using the historical value, or is there depreciation?
Well, look, we're not going to be able to teach the whole class on this one slide. Okay. So,
yeah, there.
Okay, but you get the principle right here on this asset equal liabilities plus stockholders equity. But yeah, to answer your question, you would be calculating depreciation and whatnot. It would be net of that depreciation that the asset is carried, et cetera. But yeah, I'm just going to try to keep us.
Yeah, sorry. I will.
Yeah. Okay. Okay, good. And this just repeats what we saw in the previous slides, okay? Most important thing, we need to understand this right here. So we're cool with this, assets equal liabilities plus stockholders equity. Sorry, I didn't mean to cut you off. We're good, Matthew?
Yeah. No, I'm getting a little out of scope, I think. Sorry.
No, it's okay. I'm sorry. You're trying to learn and I'm being an ass. I apologize. Okay, it's no other way to put it. Part of the problem is, guys, I've been looking at this stuff for 32 years. So forgive me if sometimes I sound like I'm being impatient. What I'm more trying to do is keep us from maybe going down a path that might make it harder for us to understand. So, okay. But if there's ever something I say that you don't understand, because there's things that I look at it and I can't even comprehend not understanding something, or I won't point something out because it's just part of my reflex. It's part of my DNA now. If I'm lucky enough to live as long as my dad did, I might be sitting on a park bench somewhere. They'll say, "What's your name, sir?" I'll say, "I don't know," but I'll say, "But assets equal liabilities with stockholders equity." Okay, so it's probably the last thing I'll forget, but okay. All right. So anyway, let's just look at this silly little example here, guys. And I know this is a little bit sloppy, but I did this for a student one time. And after I walked them through this example, they seemed to understand some things. So I just went ahead and saved this and thought, okay, I'm just going to go through this with all my students in my classes so they kind of, benefit off this one little dumb little example. Okay. So let's say I'm sitting in my house and I don't have any money. Okay. Now, if you're sitting in your house and you don't have any money, are you happy? And some people say, well, yeah, money doesn't buy happiness. Well, people who say that have money, okay? If you don't have any money, then you're sitting there and you're saying, I'm not happy. I want some money, right? Okay. So you're trying to figure out what you should do. And you look in your backyard and you sit there and you have a lemon tree. Now, the lemon tree costs you $20 and there's 20 lemons on there. So that means you have what? 20 lemons that are worth $1 each. So you get the great idea of forming a corporation. You're going to form a corporation and you're going to take those lemons, which are your personal asset, and you're going to bring them into the corporation, okay? And in exchange, you're going to take back $20 worth of stock. You're going to take $20 worth of stock back, okay? Now you're taking that stock back because you want to show that you have ownership in those lemons. If somebody were to come around later on and say, hey, I own those lemons that are in that corporation, you say, no, as owner of this corporation, I own the stock, the corporation owns the lemons, I own the stock, so I have a right to those assets that are sitting in the corporation. So at the very beginning of the year, of year one here that we're dealing with, the very beginning of the year, we have what? $20 of lemons. That's an asset because it has future economic benefit. You're thinking you're going to sell those lemons in your business, and you have what? You have stock of $20. The balance sheet balances. Our initial balance sheet balances, lemons $20, stock $20. Question. Okay. All right, good. So now I want to sell those lemons. Now, do I want to sell the lemons for $1 each? No, I'm not going to get any further, and I'm not going to increase my wealth by selling the lemons for $20. I need to figure out a way to sell them for more than $20. I'm going to sell these lemons for $5, not $5 each, but I want to sell these lemons for $3 each. Now, what could you do to differentiate lemons so that you could sell them for $3 each? And don't say lemonade. We just got to sell the lemons now. I don't want to get into, because then we'd have to start bringing water and sugar and whatnot into this to make lemonade. I want to sell these lemons, and I want to figure out a way to differentiate them so people will pay $3 each. Thoughts? Come on, my entrepreneurs.
You could bless them.
You put a brand on them.
Okay, maybe put a brand on them, say John's Fine Lemons, right? Like no other or whatever, right? And people say, oh, wow, that sounds like a great lemon, right? I don't know. Maybe I start spinning the lemons so that people think, wow, look at how well those lemons spin, whatever. They start, for whatever reason, I've created value that allows me to sell those lemons above my cost, above the $1 each. So let's say I sell 5 lemons at $3 each. I now have revenue of $15. I sold them for $3, 5 lemons, that's revenue, $15. Anytime you generate future economic benefit by whatever line of business you're in, we call that a revenue. So we report revenue here of $15. Okay. Now what happens? Those lemons cost us $1 each, didn't they? They cost us $1 each. So we would have to sit there and say, well, look, $1 each times the 5 lemon cost of, and they typically don't call it out by particular item. I'm saying cost of lemons sold. This is typically called cost of goods sold. We saw that on Apple's financial reports. Revenue minus the cost of whatever we sold to generate that revenue gives us here gross profit. And our gross profit is $10. Now, nobody ever looks at gross profit and says, hey, gross profit, go on a diet, mix in a salad. We want a nice, fat, happy gross profit. We want a nice margin there. That gross profit, in fact, it's sometimes called gross margin, shows everybody what we have left over to cover our operating expenses after we have sold whatever it is, after we've covered the cost of selling whatever it is we're selling. So you don't want a skinny gross profit because you want to have a little fat there to then cover your operating expenses. So we would report gross profit here. That's a pretty good gross profit, $10 off of $15 revenue. That's what, about a 2/3, 66% gross profit margin, something like that. Okay. Now what happens? We look at that lemon tree and we see that the lemon tree is looking a little, tired because we've been pulling lemons off of it and selling those. So we say, well, we don't want the lemon tree to die. So what do? We sit there and we go to the fertilizer store. We hand the guy $7. We pay $7 for a bag of fertilizer. And we take that bag of fertilizer back to our lemon tree and we dump the whole thing on the ground. Does that bag of fertilizer have any more future economic benefit? Now that we've dumped it all on the ground, and don't worry about, we could get into agricultural accounting here and, then this whole example would start to collapse. Just think of it at a very basic level. If you dump something on the ground, does it have any more future economic benefit?
No.
No. So the future economic benefit has what? Has expired. That future economic benefit has expired. We report that as, and I'm saying it funky like this on purpose, is reported as an expense because there is no future economic benefit associated with that. So we have our what? Our gross profit minus our expenses gives us net income of $3. There's our income statement. We just prepared our income statement. Revenues minus the cost of lemons gives us gross profit, minus our expenses, our fertilizer gives us net income of $3. There's our first income statement. Okay. Okay, good. Now we can go ahead and figure out our retained earnings and our balance sheet here. And so what happens? Well, we had cash sales of 15, but we spent 7 on the fertilizer. So we have $8 left of cash. Any question on that? Just think of your own wallet. You sold stuff for $15. You got $15 in your wallet. You reach into your wallet, you pull out $7. You got $8 left. So we've got cash of $8. Lemons, we still got what? 15 lemons. We started with 20. We sold 5. So we still have those 15 lemons that cost us $1 each. So that's $15 of lemons. So our total assets, the cash plus the lemons, are 23. Our stock, we issued that stock at the beginning of the year. We didn't issue any more stock during the year, so our stock is still 20. And our retained earnings is what? 3. If we were to analyze retained earnings, again, beginning balance, where do I want to write this? Beginning balance in the retained earnings was what? 0. Our net income was 3. Dividend was how much? 0. I didn't talk about any dividends. So the ending balance in retained earnings, sorry guys, I know it's kind of hard to see there, but the ending balance in retained earnings is what? Is 3. That's where I come up with this 3 right here. So my what? My stockholders equity is 23. I don't have any liabilities, but the balance sheet balances assets equal stockholders equity, the stock of 20 plus the retained earnings of 3. Does the balance sheet balance?
Yeah, I just I was looking away from the screen when you wrote this. Is that HI for 3? What I don't know what the $3 is.
$3 is net income.
Oh, net income of
That's
3.
NI.
Okay.
Yeah, it's the $3 of net income. That's how retained earnings works. That's the piggy bank. Beginning balance plus net income. Dividends was 0. Ending balance is 3. That's where I got this 3 from.
Got it.
Does the balance sheet balance? Assets equal, there's no liabilities. So assets just equal stockholders' equity here. Question?
The three, the net income, is that what would be taxed theoretically? So that the
Yeah.
taxable income?
Yes. We won't get into tax in this class, but yes, you'd have to pay tax on that net income. So tax is reported as an expense because it's a cost we have to pay in the generation of net income. So when we prepare our financial report, we'd have revenue, then we have operating expenses, operating items, non-operating items, and then tax. And tax is sort of reported as a separate item, but it's an expense.
Okay, that makes sense. This might be off topic, but if you were to say it cost me $3 to go to the store and get the fertilizer, could you put that on the subtracting the gross profit, so your net income is zero, and you wouldn't get taxed at all?
If you had other expenses that were legitimate business expenses, you could have net income of zero, yes. And you better have those documented so that when the Internal Revenue Service calls you and says, how come you never report net income? You can say, well, looky, I don't have a very successful business. That's why. And after 7 years of that, the IRS will say, well, that's a hobby then.
Sounds good.
Yeah. I think it's 7 years. I forget now. And maybe it's not 7 years. I think it's 3 years if you don't generate any income. IRS can start to ask you if you have a business. And I think the 7-year thing, the burden of proof falls on you to prove that you do have a business, as opposed to them proving you do not have a business. But at some point, they're going to come and ask you some questions. Okay. Now, if you have losses in any given year, the corporate tax law is, and again, we're not going to get too often to taxes here, guys, in this class, but the corporate tax law currently is that if you have losses, you can carry those forward for 20 years. So you can carry those losses forward against future years' income. They'll allow you to do that. You used to be able to carry them back and get a refund for previous years under the Tax Cut and Jobs Act. They put it so that you can only carry them forward for 20 years. Now, before you start weeping too loudly for corporations, they also lowered the corporate tax rate from around 30-something% to 20%. But okay. Any other question? All right, so we go through year one, and our business does pretty good. So now we're going to go into year two. That's what's on this slide now. So we go into year two. And in year two, we sell 7 lemons. We sell them for $3 each. Remember, we were selling our lemons for $3 each. So we sell 7 lemons. So now our revenue is what? 21. Our cost of goods sold, our cost of lemons sold, each lemon cost us $1. So that means that we have what? We have cost of goods sold of 7, gross profit of 14. Now, our business is doing so well that we think, don't change anything from what we did last year. It worked for us last year. Let's make it work this year. So we go back to the fertilizer store and we're going to buy that $7 bag of fertilizer. But this time the fertilizer guy recognizes us, the nursery store, whatever, the farming supply store, the fertilizer store guy recognizes us. He says, aren't you the person that was in here last year and bought some fertilizer? And I said, well, as a matter of fact, yes, I am. He says, I heard about you. You're an up-and-coming lemon ranch tycoon. He says, don't worry about paying me right now. Just take the bag of fertilizer and pay me next year. Don't worry about it. Now, why is the person doing that? Why is the fertilizer guy willing to do that? Willing to let me take his hard-earned bag of fertilizer that he had to get into inventory there for me to come to buy it. He incurred all the risk of putting his fertilizer store. And he just lets me take the bag of fertilizer, and only on my promise to pay him later. That's the only thing he has is my promise to pay. Why would he do that? Or she do that?
Because if your business is growing, then you could have a partnership down the line where he could earn more.
He's my guy now, right? I mean, when I go buy fertilizer, I'm going there. And he's seeing, hey, pretty soon, John isn't going to need a bag of fertilizer. He's going to need a whole warehouse full of fertilizer. And I guess we learned from the experience in Beirut, we better keep that under control because that stuff is explosive. But eventually, he's going to need a whole bunch of fertilizer. And so I'm going to lend him credit, right? So, our president says, make America great again, and I'm making America great. What made America great, guys, is credit. All of these buildings and houses and everything you see, credit. That's what spurred the growth in the economy like no other since the 1930s, okay? When they passed the 1934 Housing Act, what the federal government said is we'll back the loans for homes. Before then, you had to pay cash for a home. Once the federal government stepped up and said, no, go ahead and lend families the money to build their home, and if they can't pay, we'll back that. That caused a tremendous growth in the economy since that time. Our economy was sort of this, this sort of lazy thing moving along very slowly. You look from the 1930s and of course World War II and whatnot forward, that's when you start to see the tremendous growth in the economy. And it was the growth of credit, of allowing individuals to borrow the money and then pay that back. That's why the housing market is so important. What happens? Can you put an old car in front of a new house? No, you get a new house, you got to get a new car. Can you put old furniture and old appliances in a new house? No. Can you put old floors in a new house? No. All of those different things that are made to basically support the housing market is a tremendous boom to the economy. That's why they let you deduct your interest that you pay on your mortgage or your home. They let you deduct that against your tax because they know that that helps to spur investment in homes, and they get very nervous when the housing market starts to go down. That's why you hear a lot of criticism about the troubled asset relief program that was brought in under the Obama administration, and the Making Homes Affordable program that came in under the Obama administration. And what they were doing there was they told the purchasers, what happens is when they give you a mortgage, they don't keep that mortgage. The bank bundles that mortgage and then sells it to Fannie Mae and Freddie Mac. They sell those to them. They create securities out of those, and then they sell mortgage-backed securities. And what the federal government did in 2008, we were ready to go over the edge, okay? And with the economy, and what the federal government did when they passed the Making Homes Affordable and the Troubled Asset Relief Program is they told purchasers of Fannie and Freddie securities, keep buying those. If you suffer losses on those, we'll back those losses. That kept what they call securitization markets open, and that had a lot to do with the fact that we, probably more than a lot of other countries, came out of the 2008 financial crisis pretty good, and you see a sort of steady increase that has gone since then. Of course, now we're down in a trough because of the virus, but that's a whole nother story. So anyway, back to our story about this fertilizer. So we buy the fertilizer, but he doesn't make us pay for it right away. Now we take the fertilizer and we do just like we did last year, we pour it on the ground. Is there any more future economic benefit with that bag of fertilizer? We dumped it on the ground, just like we did last year. No more future economic benefit associated with that, right? So we still report it as an expense. And now we have what? We have a bill of $7. We're going to have to pay that, okay? So what happens when we calculate our net income. Our gross profit minus our expenses gives us $7 of net income. Let's look at our balance sheet. Our balance sheet is going to be what? Well, our cash is 29, and sometimes students have trouble with that. So let me make sure. Last year we had what? $8. This year we brought in what? $21. So 8 plus 21 gives us how much cash? Just think of your wallet. $29. Okay. Our lemons, what? Last year, we ended the year with what? 15 lemons. This year, we sold what? We sold 7 lemons. 15 minus 7 means we have how many lemons left? 8 lemons. So our assets are what? 29 plus 8 is 37. Our liabilities are what? 7, because we haven't paid the fertilizer guy yet, right? So we only have $7. We have $7 of liabilities. Our common stock stays the same. Our common stock hasn't changed. It's still $20. That's that common stock we issued at the beginning of the corporation last year. Our retained earnings had what? Now our retained earnings had a beginning balance of 3. This is NI. NI is my net income. Net income is how much? 7 this year. Dividend is how much? Dividend is still 0. So now my retained earnings has an ending balance of 10, right? Which is what you see right there. Question, does the balance sheet balance? Does the balance sheet balance? $37 worth of assets. Assets equal what? Liabilities. $7 liabilities plus my stockholders' equity. Stockholders' equity is consisted of common stock and retained earnings. So that's what? $30 of stockholders' equity plus the liabilities, 7 is 37. Assets, 29 plus 8 is 37. The balance sheet balances. Okay. Now, let's say I decide now that I need to pull a dividend out. So I'm going to pull some cash out of the piggy bank. So if I pull cash out of the corporate accounts, I'm going to pull cash out of the corporate accounts so I can go buy a hamburger, right? And so what happens? Now my cash is going to go from what? It never lets me erase. It's going to go from 29 to what? 28. My assets are going to go from 37 to what? 36. Right? My dividend now, instead of being 0, is going to be $1. So now my retained earnings is 9. I don't know if you can see that. My retained earnings is now 9. I'll write it over there. My retained earnings is now 9. So now instead of what, having this 10 here, I'm going to have what? I'm going to have 9. Does the balance sheet balance? 27 plus 9 is 36. My assets are 36. So the balance sheet still balances when I pull out a dividend. In this case, I'm assuming a cash dividend, which is generally the case. Question on that? Question? Okay, good. So when you look at the accounting equation that we've been talking about, assets equal liabilities plus stockholders' equity, and we see that our stockholders' equity in the early going here in the class is always going to be common stock and retained earnings. But you see that the dynamic part of the stockholders' equity really is the retained earnings, and that we will have our, and this is basically depicting our income statement. We'll have our income statement. IS in this class will forever, from now on, be income statement. We have our income statement. Revenue minus expenses gave us what? Net income. We added that to retained earnings, the piggy bank, right? And then we subtracted out what? We subtracted out dividends. So dividend has the same effect on retained earnings as what? As expenses do, but we do not report a dividend as an expense. We report it as a subtract from retained earnings. So when you think about dividend, think of the piggy bank. The piggy bank was what? Beginning balance of retained earnings plus the net income. We don't put revenues and expenses on the retained statement of retained earnings. We just report net income, and then we subtract dividends, not off the income statement, not in the calculation of net income. We report it as a what? Subtract straight from retained earnings to calculate the ending balance of retained earnings. But it has the same impact as what? As an expense, but the question is, where do we report it? We don't report it on the income statement. We report it directly on the statement of retained earnings. Question? Okay, good. All right, so let's look at those same statements we looked at a minute ago now with that little example in mind, which is what? This is the same set of financials we looked at a minute ago. Remember I said first we prepare the income statement, right? Revenue minus expenses is net income. We take our net income and we put it where? We put it in our piggy bank, right? Okay. Our piggy bank has the beginning balance. If you just started the business, that's zero. We put our net income into the piggy bank. We subtract our dividend. That gives us the ending balance of retained earnings. Again, notice that expenses are not, the dividends, I should say, are not, expenses are, dividends are not reported on the income statement. They are direct subtract down here on the statement of retained earnings, right? Okay. Then what? Then we prepare our balance sheet. Assets will always equal liabilities plus stockholders' equity. Assets have future economic benefit. Liabilities are bills, like that fertilizer bill that we owed. Stockholders' equity is always, for the beginning of the class here anyway, going to be comprised of common stock and my retained earnings and my balance sheet balances. Question? Okay, and then we'll get with statement of cash flows a little bit later in the class. Okay, so what we're going to do is a little exercise here together. It might be a good time to unmute. Okay, go ahead and unmute. See if that'll work. I don't know. Maybe we'll have too much residual noise. We'll have to mute back. But let's just go ahead and let's try this, because I'm going to ask you to kind of call out and tell me how you think these transactions are going to affect these various accounts, assets, liabilities, stockholders' equity. Okay, now this is that reflex part of accounting that I talked to you about. Remember I said this class is more like playing a piano than it is, say, an economics class where you have to remember supply and demand equal equilibrium or something, okay? It's not like that. This class is more, can you read about a transaction and understand how it's going to affect the financial statement line items that we've been talking about. What are the financial statement line items? Assets, liabilities, what? Stockholders' equity, which is our common stock and our retained earnings, or what? Our income statement items, revenues, expenses, right? Or our dividend, which is not an income statement item. That's reported on the statement of retained earnings, right? So let's just go through it together and see how we think these transactions are going to be described to us are going to affect these different accounts that you see listed here: assets, liabilities, and then we have our stockholders equity. But remember, our stockholders equity is what? Common stock and retained earnings. And so we know that our retained earnings is affected by our net income, our revenue minus our expenses. Net income goes into the retained earnings, and the dividends come out of retained earnings. Okay, and see if we can keep this equation in balance. So Ray and Barbara Neal decided to open a computer programming service. I think it's a little bit funny that he names it. Why wouldn't they both decide what to name it? But he decides to name it SoftBite. And on September 1st, 2015, they invest $15,000 cash in exchange for common stock. So the way this exercise works, what asset is going to increase if you put cash into the corporation and you take back stock? What asset will increase?
Yes.
Good. Not a trick question. I put cash in the corporation. So cash is going to increase. Now, cash has to equal liabilities plus stockholders' equity. So something on the other side of the equation is going to have to increase. Do you think it's going to be accounts payable, common stock, or retained earnings?
Common stock.
Good. Just like we did when we first invested those lemons. In our case, it was lemons. Here it's cash. And that's typically how a corporation gets started. You pay in some cash. You take back some. It could be common stock. It could be preferred stock. We'll get into that a little bit later in Chapter 8 when we talk about stockholders' equity. For now, just go ahead and accept that it's common stock that gets issued in exchange for cash. Does the equation still equal? The balance sheet still balances. Okay? Okay, good. Now, again, remember, we got to get used to reacting to a transaction and knowing how it's going to affect our various asset, liability, stockholders' equity accounts. So we purchase equipment for cash. If you purchase equipment for cash, is my cash going to go up or down?
Down.
Down.
Good. How about what? Equipment's going to go up. So the equation will stay in balance, won't it? Okay, because everything happened on one side of the equal sign. Okay, good. Still balances. Okay. Okay, good. Now we are going to do what? Purchase supplies on credit. And this is the kind of thing I need your help with, guys. When I see purchase supplies on credit, that automatically means to me that they're going to have a liability. I don't even think about that anymore. You may look at this kind of stuff and say, how do we know that they weren't going to pay later? And the answer is because it said it was on credit. Okay, so if you don't understand something like that, you need to shout that out to me so I remember to slow down enough to explain it to you, right? So if you purchase something on credit, that means you're going to pay later, right? That means you're going to have a bill. You put something on your credit card, you got to pay it later, don't you? So you're going to have a bill. And they tell me that they buy some computer paper or whatever expected to last several months. Why is this question telling me it's expected to last several months?
Similar with the fertilizer.
Well, it's different than the fertilizer. The fertilizer wasn't going to last several months. I was dumping it on the ground, although I'm sure it probably does have some benefit. It's going to help the tree grow, but we're just assuming the future economic benefit expired, right? Here, they're saying it's going to last several months, so that means what?
Liar. Up.
Well, is several
don't
months
last
in the
forever.
future? Several months in the future or in the past? That's not a
Future.
good question.
Future.
Several months is in the future, so they're telling me that, so I know that I have an asset because it's going to have what? Future economic benefit, right? Okay, so since it's going to last several months, I know I have to increase an asset account. What asset account do you think? Supplies, right? Okay, so I'm going to increase the supplies account. Now, either an asset's going to have to come down or a liability is going to have to go up to make this equation balance. What do you think?
Cash. Get subtracted from liabilities.
Cash gonna get subtracted from liabilities.
Accounts payable.
If I was paying the liability, then I would subtract the amount of cash I paid from the liability. But accounts payable is going to do what?
Go
It's
up.
going to decrease, isn't it?
Right.
And then,
Bill? Huh?
and then supplies will go up too to keep it balanced.
Correct. Let me just show you, right? So the supplies are going to go up. Accounts payable is going to go up. The equation stays in balance, just like when I sat there and, well, it's a little different than the fertilizer because the fertilizer expense. So never mind, forget the fertilizer example. My liability went what? My liability went up, didn't it? And I have this future economic benefit now. These paper supplies are going to last for several months. Question? Okay, good. Let's try another transaction, see how we can react to this one. I received $1,200 from cash for program services it has provided. So when I provide service and I charge for that, since I'm in the business of programming here, that is going to be a revenue. So my revenue will go up. So something on the other side has to go up, or something on the same side has to go down. What do you think?
Cash go up.
Receive cash, cash goes up, and my revenue goes up. And the equation stays in balance. Okay. Now, if I were to prepare my income statement right now, I would have what? I'd have revenue of 12. I'd have expenses of how much? Right now, just looking at this spreadsheet, how much expense would I have?
Zero.
Zero, good. And so I'd have net income of how much?
500.
Net income of 1,200. And so what would happen? My retained earnings would go up, wouldn't it? 1,200?
Yeah. Yep.
So since my retained earnings would go up 1,200, that's how the balance sheet stays in balance. So the balance sheet needs what? The retained earnings, the net income, excuse me, to roll into the retained earnings in order for the balance sheet to balance, right? Okay. All right, good. Let's look at this one. I receive a bill for $250 from the Daily News for advertising, but postpones the payment until a later date. Now, this is a little confusing because you could look and you could think that, well, wait a minute, advertising should have future economic benefit, right? But because I don't know what accounting period that future economic benefit falls into, then often what FASB tells us about advertising expenses, you should just expense it. If you can't discern what period it benefits, just assume that the benefit expires as soon as you acquire that advertising, okay? So I'm telling you ahead of time right now, the advertising is going to be an expense. If they told me the ads won't run until next year, then maybe that would have future economic benefit, okay? So this is not the best example of an expense because it kind of depends. But if they don't tell you that it's going to benefit the future, if you can't tell for sure whether it benefits the future or not, you just treat it as an expense. Rule of conservatism, just take it as an expense. Don't assume it has future economic benefit unless you have some evidence that it will. The ads are going to run later, whatever evidence you'd have that it will have future economic benefit. Typically, advertising is treated as an expense. So I know expenses are going to go up. And if I received a bill, what else is going to go up?
Liability.
My liabilities, the liability called account payable, and I'm saying it weird like that, so we get used to realizing that payables are bills, right? Are our liabilities, okay? Good, so our accounts payable goes up. Our expenses do what? Our expenses go up. If my expenses go up, my net income comes down. If my net income comes down, my retained earnings comes down. If my retained earnings comes down, my stockholders' equity comes down. The equation stays in balance because what? Liability went up, expenses went up, net income did what? Net income came down, so retained earnings came down. So my stockholders' equity came down. So assets equal liabilities plus stockholders' equity, right? Which went down. Let's just think about that from the standpoint of the income statement. Let's do the income statement again. Revenue was 12. Expenses were what?
250.
Right. So somebody help me with the math here, guys. By the way, I'm horrible with math. I don't do anything without a calculator. You say, John, what's 5 minus 3? I say, hang on a minute. And I put it in my calculator, okay? So revenue minus expenses is what?
950.
950.
Thank you. 950. So what happened? My net income before was 12. Now it's 950. So my net income came down, didn't it? From the 12 to the 950. If my net income comes down, my retained earnings comes down. If my retained earnings comes down, my stockholders' equity comes down. Assets equal liabilities plus stockholders' equity. Liabilities went up. Stockholders' equity went down. The equation stayed in balance, right?
Yes.
Say that again. No, we're good?
We're good.
Okay. Okay, good. I go through that because that's a little confusing because you see that minus there and you're saying, what, did expenses go down? No, they went up, but they're subtract from revenue in the calculation of net income, right? Okay, good. SoftBank provides $3,500 of programming services for customers. The company receives cash of 15 and it bills the balance of 2. Okay, so if we provided service for 3,500, okay, is our revenue going to go up?
Yes.
If you provide the service, your revenue goes up. So we know revenue is going to go up 3,500. Now we're only going to get what? 1,500 of cash up front, and we'll allow them to pay us the remaining 2,000 later on account. Would you do this?
How credible are they?
Huh?
How credible are they to actually pay you back?
They've got a credit rating of 850.
Oh yeah.
Would you do it?
Yeah.
I say the credit rating of 850 because my, I don't know if I should get into this. I'll just tell you, my credit rating is always like at 847. And I'm like, what do I have to do to get those those 3 points more? I don't understand. What do I have to do? And it really upset me when I was dating someone and they broke up with me because I didn't have an 850. No, I'm just kidding. Okay, so it's just, well, I don't understand. What is it? They can't explain it to me. Anyway, so they say that they have a credit rating of 850. That's perfect, right? Credit. And so what happens? You sit there and you're going to do this because what? You're generating more business, right? Hey, they can't pay me now, but they have good credit. They're a good customer. Maybe you've had experience with them in the past. You know, they pay their bills on time. So you go ahead and you do it, right? So I have 2 future economic benefit assets. I have cash and I have what? And I have an account receivable. That's going to be cash pretty soon, isn't it? When they pay me. So those 2 assets go up and the revenue goes up 3,500. So very important point here. Okay. Stop if you weren't listening before and listen now. Very important point. Notice that I don't have to collect the cash to take the revenue. In what we call accrual accounting, you take the revenue when the service is provided. What causes you to recognize that revenue is not the collection of cash, but the providing of the service. And since I provided the service, I took the full 3,500 revenue, even though there's only 1,500 of cash up front, because I have that future economic benefit, that 2,000 that's coming later. Okay.
Could you say that one more time?
Yeah, what we call accrual accounting, okay, and we'll put labels on this more in chapter 3, but what we call accrual accounting says that you take the revenue when you provide the service, not when you collect the cash. You don't say, hey, wait a minute, I can't take the revenue yet because I haven't gotten the cash. They took the full 3,500, didn't they? Why? Because they had earned that revenue. They had provided that service.
Thank you.
Mm-hmm. Okay, and of course the cash they already got. Notice the same thing with the expense, guys. We did what? We took the expense for that advertising even though we haven't paid the bill yet. That's also accrual accounting. So that one was very important as well. You take the expense. Why? Because the future economic benefit expired. You don't wait until you actually pay the cash to take the expense. You take the expense when what? When the future economic benefit expires. We did that with the fertilizer. That second year, that bag of fertilizer, we hadn't paid that $7 yet we took the expense. That's accrual accounting. You take revenues when you have earned them. You take expenses when the what? Expenses incurred, when the future economic benefit expires. Expense, expires, expense. When the future economic benefit expires, you take the expense. Okay? Very important. We're going to be going over that over and over again. Okay? All right, good. Now they go ahead and they pay the following expenses in cash. So the cash comes down for the total. This is a little annoying. And we do what? We take the expenses, and the expenses go up, net income comes down, net income comes down, retained earnings comes down, stockholders equity comes down. So we're just showing you asset came down, stockholders equity came down. That's why they're putting those minuses. But keep in mind, your expenses are actually going up, right? Which is reducing your net income, reducing your retained earnings, reducing your stockholders equity. Okay, good. Now we go ahead and we pay that bill. And when we pay that advertising bill, of course, our cash goes down, our liability goes down, the equation stays in balance, right? Transaction 9, we received 600 now from those people that we had done service for, and they told us they'd pay us later. So they pay us, so cash goes up, accounts receivable goes down, the equation stays in balance. Transaction 7, we pay the dividend of 13, cash comes down, dividends do what? Dividends go up, dividends come straight out of retained earnings. If our retained earnings goes down, our stockholders equity goes down, assets equal liabilities plus stockholders equity. Have the same impact as that $1 dividend that I had paid out of our little lemon company. Okay. Question on any of these? Okay. So 2 big takeaways from this, maybe 2 or 3 big takeaways from this example, guys. Very important. What? We take revenue when it's earned. You don't worry about when we collect the cash. Once we provide the service, we take the revenue. We take expenses when they are incurred, when the future economic benefit expires. Okay. Bigger picture than that. Notice what we were doing here. We were looking at transactions and determining their effects on these financial statement accounts. Why? Because we want to generate financial statements. Look, nobody sits there and keeps track of all this stuff just to say, oh boy, I kept track of it, right? We're going to want to generate a set of financials from that. So we have our ending balances that were affected by all these transactions. Everything started out as 0. We had all of these different transactions for our first year of operation that affected all these accounts, and we end up with ending balances. So we have what? We have revenue of 47. We have expenses of 1950. Okay, that's difference is going to be our net income. Then what? Then we took our net income to our retained earnings. We subtract out our dividends, and then we're going to sit here and have our balance sheet items: cash, assets. Well, all of these are assets. Okay, our assets are what? Our liabilities plus our stockholders' equity, which is going to be the sum of our common stock plus our retained earnings. Retained earnings, revenue increases it, expenses decrease it, dividends decrease it. Okay, so just kind of keep those numbers in the back of your head. Here we go. There's our 4 financial statements. Okay, let's see them. And we've already seen these. We showed them to you now. Now you see the transactions that generated them. Revenue minus expenses gives me net income. Net income goes into the piggy bank, into my retained earnings. Out comes the dividend. That gives me what? That gives me the ending balance of my retained earnings. Then I go over to my statement of retained earnings, beginning balance. Well, I just showed you that right here. Then I go to my balance sheet. There's the cash. There's the accounts receivable. There's those supplies. There's that equipment we bought. There's my total of my assets. There's that 1,600 for that account payable. There's that common stock. Remember, they issued that stock at the very beginning. Plus the retained earnings that got brought down here. This 1,450 right here. And we end up with a balance sheet that balances. Sorry, guys, there's certain things on my screen that are getting in my way. I can't see where I'm circling sometimes, okay? But the what?
John, I have a question. When we look at those financial statements, what are we looking for? Are there like certain parameters that we especially pay attention to? And like when we're comparing financial statements of like 2 companies, what should we comparing?
Well, a couple of things that we would be interested in, if you go back to the income statement, of course, we're interested in seeing how that income is probably trending year over year. Okay, so we would be interested in seeing what sort of an upward trend in the income. Okay, if we're looking at the statement of retained earnings, it really kind of depends on what you're interested in for this investment. It can vary from investor to investor. If you're somebody my age, I'm taking a good look at that dividend line. I'd like to see how frequently they're paying out dividends, because I need to get to a point in my life where I'm sitting in my backyard getting drunk, and I want to see how cash is going to be coming in. Someone your age is saying, I don't want a company that's paying dividend. I want a company that's hanging on to their income and reinvesting it in the company so that we have a growth stock of some sort, right? It's going to grow over time. If you're taking a look at your balance sheet, then you start taking a look at things like, and we're going to talk about at the end of chapter 2, maybe something like the debt to equity ratio. Okay, how much debt do they have to equity? Because you don't want a company that is so leveraged that almost all of their assets are being gobbled up by debt, right? So you'd probably want a debt to equity ratio, and it depends on the industry, depends on the stage of growth that the entity is in, but you probably don't want a debt to equity ratio that's getting much above where debt is gobbling up 60% of the assets. Okay, so debt to equity ratio, you don't want to be too high. You could be comparing the accounts receivable collectability, right? So what we would do is we would look at accounts receivable and see to what extent they're collecting on that. Is it taking them 30 days to collect the receivables, 60 days, 90 days? The company starts getting, into a 90-day collection pattern. There's some problem there. What's going on? Is their product not very good? People aren't wanting to pay. Do they not have a good, we talked about checking the credit. Maybe their credit procedures need some work. Supplies, I'm looking at supplies and I'm thinking, well, okay, well, we're not mentioning inventory here, but inventory might be something where I look to see how long it takes them to turn over their inventory. If it's taking them too long to turn over their inventory, then maybe they have a slow moving inventory. Now, again, that depends on the industry, right? If it's a real estate type industry, maybe I'm okay with a 30, 60, 90-day period to turn over their inventory. If it's a sushi restaurant, I want them to be turning over their inventory daily, right? So that really depends on industry, etc. Okay, so there's a bunch of different analysis that you can do. We won't spend too much time with this, but that's the nature of the kinds of things that you would be analyzing as you're looking at these financials. This is not a financial statement analysis class, guys. I think they have you doing that some other place. What my job here is to make you comfortable with the procedures that are used to generate these statements and understand the nature of the elements that are on here.
Thank you.
Okay. Good question. Guys, you know, sometimes I give the speech about becoming an accountant, becoming a CPA, you know, something that I've seen a lot of my students do well with over the years, moving into the different, you know, different positions over the years. I'm sure by now I have some students that passed the CPA exam a long, long time ago that are now, you know, partners at a public accounting firm. This thing needs to be updated. You know, they talk about partner at a public accounting firm somewhere in here. I always have to laugh, you know, chief financial officer. Okay, let's just look at this. I mean, if you told, what's the guy's name that runs Apple, Cook, that he was going to make this per year, he would weep openly. Okay, so, you know, these numbers are not relative to the Bay Area, obviously, in different parts of the country, but something to think about, you know, how different financial positions can leverage into some pretty nice income levels. Okay.
John, I have a quick question for you.
Yeah.
Can you kindly repeat the 2 rule of thumb or 2 takeaways after we finish the transaction step 1 to step 10?
Yeah, I can. I'm going to go back to that slide though, because it puts me back to my memory, because sometimes I say things and I don't remember what I said. But I think what I said is there's probably like 3 takeaways there. One is that we take the revenue when we have earned it, when we provided the service, not when we collect the cash. You don't worry about when you collect the cash, you worry about, have you provided the service? That's accrual accounting. Expenses are recognized when incurred. When did the future economic benefit expire? Not when you actually pay the cash, right? So we took the expense for the advertising, even though we didn't pay the cash until later, right? And then the sort of bigger picture is that this class is all about seeing a transaction, knowing what, how to react. How does this transaction affect these different accounts? Does it increase them? Does it decrease them? And then we use that, what, understanding to generate these totals down here that we then pull together into the financial statements.
Acknowledged. Thank you.
That's more of what this class is about than anything, guys. Okay. And so sometimes that's kind of, I don't know if it's hard or disappointing or annoying. It is what it is. It's an accounting class. We're teaching you how to do something, how to sit there and look through transactions and know what, know how to react to those transactions so that you can then generate a set of financials. It's not really till the end that we start to get more into using these statements for internal type decision making. Okay. In other words, if I'm the management of this company and I'm seeing this information, how can I use this information to help me make decisions as to the pricing of my product, that kind of thing. But we really deal with that towards the end. Chapter 13, we'll talk some more about some of these analysis tools, but we really don't spend a lot of time with that. Chapter 13, if you blink, you miss it. Okay, so what we have here is the example of the practice midterm. Okay, now the actual midterm will look like this minus the yellow highlighting answers. Okay, but they will be multiple choice questions for at the most 5 choices. It'll be given right here in Canvas. I cannot imagine you guys not acing this thing. I am not here to give you some horribly difficult test with layers of nuance and complexity. I'm here to say, can you walk away with a pretty solid comfort with this financial reports? And if you can answer these questions, you demonstrated that to me. Where I come from, that's a touchdown. We're moving on and we're sending you on to, you know, the next big adventure. Okay. All right. So let's just go ahead and let's take a look at some of these questions though. Which of the following is not an external user? Remember, external users are those that are outside the company, right? So regulatory agencies are what? Outside the entity, SEC, IRS. Are customers outside the entity? Yes. And sometimes I get students that'll say no to that. And I'm like, well, wait a minute. If you're at Nordstrom buying something and the phone starts ringing on the other side of the counter, do you go on the other side of the counter and say, hello, can I help you? No, you know that's not your phone. You are outside there. You're not part of the company, right? So customers are outside of the company. Are investors outside of the company? Yes, they are. We consider them what? They're actually considered one of our primary external users, right? Okay. Okay, good. Which of the following is a primary user of accounting information? And we said what? Our investors and our creditors. Investors are people that buy stock. Creditors are people that loan us money, right? Okay, so, or lend us credit, like the fertilizer guy, right? So which of the following is a primary user? Creditor, right? Investors and creditors. SEC, IRS, they're external users, they're regulatory entities, but they are not what? They are not primary users. And of course, D is not right because creditors are primary users, okay? All right, every now and then we'll have stuff like this, guys. It'll be an in-practice midterm teaching moment. I did not talk about this on the slides. I did not talk about this in the lecture from the other day, our first meeting, okay? So I'm just gonna explain to you what this is all about right here. So I kind of started to tell you about it, but I didn't go all the way to putting a label on what they ended up doing. So remember I told you that there was this thing where people were saying it's not a question of if, but when the United States turns over to the International Accounting Standards Board requirements, the IFRS, International Financial Reporting Standards, I used to sit there and think, guys, there's a lot in this country that doesn't happen like that, right? There's a lobbying process. And the companies went to Congress and said, we don't want to use IFRS. Don't make us use IFRS. And so Congress put the freeze on FASB to require companies, put the freeze, I should say, on SEC to require companies to use IFRS. So FASB and the International Accounting Standards Board got together and said, let's do this. Let's operate off the same conceptual framework, and where we can, we'll issue joint standards where we can see common ground that we can issue standards under. The most recent example of that, or maybe, I don't know if it's most recent, but the most significant example of that, most recent significant example of that is revenue recognition. Okay, so they came out with a joint standard. That process of working off the same conceptual framework and where possible issuing joint standards is called convergence. The standards differences are here, and they're thinking over years, those will converge. And it really becomes a function of what? Of the political process that we've talked about, what's going on around the world, what's going on in the US, and see if over time, the line between US GAAP and the international standards will start to blur to where there is eventually not as much as a significant difference between the two. That's called convergence. Okay. Okay, good. Let's take a look. And liabilities of a company would not include, well, liabilities are our bills, aren't they? So is a note pay a bill? A bill? Yeah. is an account payable. A bill. The only difference between a note and an account payable is a note payable is a little more formal. It has to have certain elements that make it a note, but both of them are bills. Account pay a bill, a note pay a bill, salaries and wages pay a bill. If somebody does some work for you, you owe them their salary, that's a bill, right? Cash is what? Cash is an asset. In fact, I would venture to say it is your favorite asset, and that you can turn it into any future economic benefit you want, of course, within the confines of the law, right? Okay,
can we talk about this one for just 1 second? The wages and expenses didn't come out of liabilities in the last example. So is wages payable, is that a different category?
Okay, I don't, did we have salaries in the previous example?
Yeah, we had salaries and wages that were $900, and that came out of expenses.
Okay, well, let's go back to that one.
So it wasn't a liability, and is that just a time function?
Well, no, it's not a liability because I paid it.
Okay.
What am I doing? Right on that. I've got a separate screen up here, guys, where I can see it the way you're seeing it. We paid it, so it's not a liability. If we hadn't paid it yet, then it still would have been, let's say for a second, all of these were wages. I mean, I know they had different things here, but let's say all of them were wages and we hadn't paid it yet. We wouldn't obviously be able to decrease cash. We would increase liability, right? Salaries pay a bill in that case, and this equation would have stayed in balance, right? This
Okay.
cash wouldn't have gone down. So all we're saying here is that if you don't pay the salaries, and that happens, right? Someone does the work, but we pay them what, we pay them, what is that, bi-weekly or bi-monthly? I forget, semi-monthly, whatever. We pay them every 2 weeks. Okay, so if we pay them every 2 weeks, at the end of the first week, they've done the work, but we haven't paid them yet, right? So if we went to go prepare our financial statements and the financial statements ended, the year ended, our reporting period ended in between payment dates, we'd have to record a liability because their future economic benefit of their service has expired, hasn't it? So in that case, we would take the expense because the future economic benefit has expired, and now we have a bill. Go ahead, try it sometime. Have people do work for you and then tell the court you're not going to pay them. The courts have little sense of humor when it comes to stuff like that. They're going to say, no, Judge Judy's going to come down on you. No, you're going to pay this person, right? Because they did the work already. Okay?
Yeah, thank you.
Okay, so yeah, it is let's go back to the practice midterm. Sorry, guys, I've flipped through this. It is where are we? Right here, it's a liability, right? The only one of these, it's not a liability, is cash. With my exams, guys, I'm telling you, I give you plenty of time to work the exams. You get 3 hours to work 30 multiple choice questions. Read through every choice, because sometimes you're in a hurry, you're nervous, something, and you don't notice that not. And you see the first thing, you say, which liabilities would include, you kind of blow past that not, you pick note pay a bill, and you say, oh, that's a liability, and boom, you hit A, and you keep going to the next question. Meanwhile, if you had just continued to read to question B, choice B, wait a minute, accounts pay a bill is always a liability. What the hell? How can there be two right answers? You go back into the question, and then you see, oh, it said which one is not. I see cash is the one that's not. And you have to bear with me a little bit. Sometimes people say, well, John, you're teaching to the exam. My teaching orientation is CPA review. So my teaching orientation is teaching people how to pass the CPA exam. So I can't factor that out of my delivery. I'm all about helping you to pass exams and that kind of stuff. So I'm not teaching you the exam. I just have an orientation of teaching that talks about how to be careful and not mess things up when you're taking an exam, okay? Okay, good. Let's look at number 9 here. Andre Dickinson, owner of Andre's Fine Wine, also owns a personal residence that costs $475,000. The market value is $625,000. During the preparation of the financial statements for Andre's Fine Wines, the accounting concept most relevant to the presentation of the home and what? Let me ask you, are we going to include the home on the financial statements of the Fine Wine Company? I mean, yeah, are we going to include the home?
No.
No. His home is what? His own personal. It's like that barber chair. Remember the barber chair that we had when we were pouring shots or whatever? We didn't include it on the what? Assets, the financial statements of the barbershop until we brought it to the barbershop, right? So his home, his personal residence would be like that barbershop, and that's governed under the economic entity assumption. Okay.
Excuse me, John. I think before the question, we were actually on the previous page. I think we didn't cover question 7 or 6.
Oh, 5. We didn't do 5.
We didn't do 5 and 6.
Yeah, because the problem was that I put the same question twice.
Oh,
so
yeah.
I came back and I saw that. I just jumped over there. Right, you're right. So let's go back and let's look at question 5 and 6. Let's look at 5, okay? Another in practice midterm teaching moment, okay? So what happens? This process that we're going to start to talk about tonight when we get into chapter 2 has been around since the 12th century. The system that we're going to use, called the system of debits and credits, has been around since the 12th century. Now, they attribute this to this Luca Pacioli. Luca Pacioli was a Catholic priest that wrote about a lot of things that were going on in 12th century Venice. So it probably was around before the 12th century. But this system got written about initially by Luca Pacioli. Back in the 12th century. Okay, so they say he invented the system that we're going to look at. He didn't invent it. He was just writing about different things that were going on and included this. Okay, but this system that we're going to really learn, and really the class is almost going to start in chapter 2, that we're going to learn about, if it's been around since the 12th century and is still in use today, what does that tell you about that system? That's a question.
It works.
It must work. It must work, or we would have abandoned it by now, right? If you don't believe me, how come we don't use the Roman numeral system anymore? Why? Because it's almost impossible. What is it? With an X, I want to divide. Go ahead. I'll wait. Divide 13 million by 3 using Roman numerals. Go ahead, I'll wait. Okay, okay, no thanks, right? So we jettisoned it for some better system. The only reason Roman numerals are even in our head anymore is because of the Super Bowl. Okay, so, we get rid of systems that don't work. So this system that we're going to talk about must be effective. What else? It works. What else? It's easy. It's got to be easy for us to still be using it after all this time. Look, if you want an airplane to fly, you're subject to the difficulties of natural science, right? Hey, the wind blows, the thing weighs so much, it won't fly unless you adhere to these properties. What's happening? For our accounting, we are simply trying to reflect the results of a business endeavor, and we're using a system, and if the system was too difficult, we would have found something easier by now. So if something could be understood by the 12th century, okay, they thought the world was flat. They thought if you went off the edge of a mountain or whatever, the edge of the not the mountain, the edge of a mountain, you really would fall. They thought if you went off the edge of the water, you fell into a dragon's mouth, right? Okay, what happens? We know better than that, right? So if they could understand this system that we're going to talk about here tonight, you're going to be able to understand it, okay? But it was originally written about by this Luca Pacioli back in the 12th century. Okay. Okay, good. Let's look at number 6. Martin Corporation purchased land for $290,000. In 2013, it purchased a nearly identical parcel of land for $460,000. In its 2013 balance sheet, Martin valued these two parcels of land at a combined value of $920,000. So what did he do? He took land, I'll call it 2007, and instead of reporting it at $290,000, what did he do? He reported it at $460,000 because he said that the 2013 land 2013 was also worth $460,000, and he brought them both up to $460,000 to what? Report a total $920,000. Is that what you're supposed to do? Land is supposed to be carried at what? At historical cost. He should have kept that land at the what? $290,000, not write it up to the $460,000. Land is his historical cost. He violated what? The historical cost principle?
Oh. Yeah.
Bad, Martin. Okay. All right, good.
This is done so that you're so that the I'm assuming that it's because the creditors need to know that your outstanding debts versus your assets would make sense.
No, it's to remove subjectivity as to how we value certain assets.
Okay.
It's taking a conservative approach to how we're reporting our assets and removing subjectivity, because things like land, you know, if you ever try to sell a house, you know, the real estate person will come in and tell you, oh yeah, your house is only worth this much, you know, and people will come in and say, yeah, your house is only worth this much. And meanwhile, you're thinking, no, my house is worth, are you kidding? My house is worth $10 million. Look at this beautiful place, right? Everybody's got a different opinion as to how much an asset should sell for. And FASB says, if that's the case, carry it at what you bought it for until a new person comes along, and when they buy that asset from you, now there's been an objective measure of that market value. There's been an arm's length transaction. Of course, if you sell it, it comes off of your balance sheet and will go onto the balance sheet of the purchaser at that arm's length transaction price because of the subjectivity of things like property, plant, and equipment. Now, if the whole world agrees as to the value of an asset at a given date and time, then we can carry that at fair market value. Can you think of an asset in which we all agree to the value of that asset at a point in time?
Stocks.
Stocks, good, very good. Stocks you can carry at fair market value because everybody agrees. The stock costs this much, and you say, oh, well, I'm going to buy the Apple stock from me for this much. You say, get out of here. This is what it's trading for at the end of the day. That's what you got to buy it for, right? And everybody agrees to that. Okay.
Also, the landowners pay way less property tax that way. If you buy it at $200,000, it's worth $120,000. You're only paying what, $2,000 a month in property tax versus.
Well, there's a lot of factors there. Property tax is based on the taxing authority's appraised value. And then it depends on what kind of property you're talking about, because in the state of California, for homes, your property tax is based on the value of when you purchased it. They call that Proposition 13. And that was done because as property values started going up, the concern was that owners of property wouldn't be able to afford the property taxes on it. And so to protect those homeowners, Howard Jarvis was the name of the guy, came up with this Proposition 13 that fixed the property taxes to whatever they were at the time you bought the property. But accounting standards say, no, leave it at historical cost. Now, we're not going to talk too much about IFRS. Well, let me ask you a question. Does this thing of keeping the property at a 1970s value make you feel a little freaky? Well, it's good. That's good that it makes you feel that way. That means you're an IFRS kind of person, because IFRS says, no, we're going to write the property up to its fair market value any point in time. And then we're going to recognize, and it doesn't hit the income statement, it goes straight to stockholders' equity through a vehicle called other comprehensive income, which is way beyond the scope of this class. But we're going to hit it into our stockholders' equity, so the balance sheet will balance, and we can sit there and write up our property values if they go up in value. So IFRS takes a different approach. We don't do that in the US because we're still afraid of the Depression and what was happening before the Depression, where companies were being very subjective in how they valued their assets, and they overinflated the values of their companies, and stockholders were harmed during the go-go 20s, investing in just spending all this money and investing, and it looked like the economy was going to keep going forever like an endless Christmas tree. And then what? Then you had the crash of the stock market when everybody realized it was all based on fluff, and that ushered in the Depression. So because of those fears, you have these kind of what really seem like old fangled kind of rules, because it's ingrained in our consciousness, what happened during the Great Depression, okay? So even though almost everyone who lived through the Great Depression is dead. In fact, probably everyone is, because the only people that are left, my dad just, died at 89. He was, born in 1930. He was, what he knows about the Depression is, his mom put tape on his shoes. He doesn't really know he didn't really know what it was actually like to be an adult with responsibilities during that time. So even though anyone who would really have experienced the Great Depression as a grown person is dead now, it is so much, somehow we're still fearful of it, and nobody even remembers what it was like. So, okay. All right, good. All right, let's go ahead then and let's take a look at the next one, the private sector organization, okay? FASB sits in the private sector. Private sector means you're not the public sector. Public sector is government entities, okay? So anything that is not a government entity is considered private sector, okay? So you have what? You have public sector, that's government. Private sector, that's everybody else. Now, I know you have public companies, but public companies, it's a little confusing, are what? In the private sector. Public sector is government entities, okay? And so the private sector organization that develops accounting standards, the Financial Accounting Standards Board, even though the SEC, which is in the public sector, has that authority, they have delegated that to this private sector. It's a not-for-profit organization called the Financial Accounting Standards Board, FASB. We saw this question a couple times now, that one, so I'm not going to read it again. We went over this one, right? Okay, so let's take a look at this one. The cost principle requires that when assets are acquired, they be recorded at, cost principle, record them at cost. Deuce company has 5 plants nationwide that cost a total of 100 million. The current value is 500 million. Under the historical cost principle, we carry that at what? 100 million, right? Historical cost. The economic entity assumption requires that we keep the activities of the owners separate from that of the business. That's right out of the slides. Okay, a small neighborhood barber shop. Okay, point here, a small entity. I don't know, you could have a barber shop, could be a corporation. So I don't know that this is the greatest question that I would sit here and ask you on your exam, but I just wanted you to understand you have what? Single owner, usually a smaller business is a sole proprietorship. 14, owner's equity is best depicted as, well, we know that assets equal liabilities plus stockholders' equity. So is it true that assets minus liabilities could equal, you know, stockholders, owner's equity? She is stockholders' equity, owner's equity. Those are synonymous terms, right? So if my assets are 100, my liabilities are 40, my stockholders' equity is 60, then you could what? Figure out your stockholders' equity by taking your assets minus your liabilities, and that difference being what? The stockholders' equity. Okay. Liabilities are future economic benefit? No, that's assets. Are existing debts and obligations? Sounds like my bills, sounds like my cell phone bill that I have to pay. Possess service potential? That sounds like the definition of an asset. Are things of value used by the business and operation? A, C, and D are all what? Are all assets. The only thing that is even close to the definition of liability is B, right? Okay. Okay, good. Let's take a look at this one. Finally, we get some numbers in some of these questions, right? So they show us the accounting equation, assets equal liabilities plus stockholders' equity. Does this equal, right? 60 plus 60 is 120. The assets are 120. Now they purchase office equipment. So if they purchase office equipment, let's just do it up here, for $15,000, is that office equipment an asset? Office equipment's an asset, so I'm going to go ahead and what? Bring in that 15,000. And they say that they will what? Where do they tell me? Purchase office equipment for 15,000. Where do they tell me that they bought it for on credit?
On account.
Oh, thank you. Okay, there it is, on account. Okay, there's another one. On account means what? You're going to pay for it later. Thank you, whoever said that. On account means you're going to pay for that later. Okay, again, these are some wording that we're going to have to get used to, right, in this class. But that means that 15,000. Sorry, guys, it's in a position there where it's kind of hard to write with this thing. That 15,000 is also going to go up, isn't it? So if you take what, the 120 plus the 15, the liabilities plus the 15, stockholders' equity wasn't affected at all by that, right? Okay. Balance sheet shows. Why do they call it the balance sheet? Because it has assets, it has liabilities, it has stockholders' equity, and assets equal liabilities plus stockholders' equity. So the balance sheet has what? Has assets, has liabilities, and has stockholders' equity on it, right? Is that what's on the balance sheet? Assets, liabilities, stockholders' equity, and they equal. That's why they call it a balance sheet. What's reported on the income statement? Net income is reported on the income statement. How do you calculate net income? Net income is what? Revenue minus expenses, and you report your net income for the accounting period, usually on an annual basis. So if someone asks you, how much money did you make? What do you tell them? Do you say, well, you mean since I was born? Let's see. Well, my mom gave me $5 one time to pick up my toys. And then my grandmother, paid me, $50 to, clean out her garage or something. No, you don't sit there and go from the day you were born. You basically tell someone, well, that's how much I made last year. My income last year was 100,000, whatever, 200,000 for you, right? Whatever it was, that was my net income. You report that by year. Well, that's what companies do as well. They report their what? They report their net income by year. So that means that what? You start each year and think of your pay stub for net income. You start each year what? With zero, right? Beginning of the year says, what is your income to date? What are your wages and salaries to date? And you're like, oh, it's only $5,000. That's because you just started the year. By the end of the year, what? It's going to be 150,000, whatever it is, right? So what happens? You start each year back to zero when you're calculating your net income, right? And so your income statement is where you report your net income. Net income is what? Revenue minus expenses, but an income statement covers what? Covers a period of time. Typically, it covers a year's worth of activity. Question on that? Okay, good. Let's look at this question. Now, this question is the nature of some that I will give you on your exam. I'm absolutely going to give you, you can bet and win that I'm going to give you this. That's a star. Okay. You can bet and win on idea that I'm going to give you a question like this. Maybe not be this exact question, probably won't be, but one very similar to this. I need you to be able to look at a set of financial statements and be able to categorize them into assets, liabilities, revenue, expenses, stockholders' equity. Okay. So in this question, I just went through and it says revenue and asset. No, it's revenue. Is retained earnings an asset? No, it's stockholders' equity, right? Is equipment an asset? Yep. Are expenses an asset? No, they're expired future economic benefit versus what? Versus future economic benefit. Is cash an asset? Your favorite. Dividends are what? Dividends are a dividend that's paid out of my retained earnings, which is part of my stockholders' equity. That's not an asset. Are supplies an asset? Yeah, supplies have future economic benefit. Accounts payable is a liability. Accounts receivable is soon to be what? Collected in cash, right? So that's got future economic benefit. That's an asset. Common stock is part of my stockholders' equity. Okay. Okay, good. Let's look at this question. Okay. And there is a typo in this question right here, guys. They want to know at December 31st, 2013. You cannot answer this question if they ask you what was stockholders' equity in 2011. It's at 12/31/13, okay, is the typo that needs to be fixed here. And they want to know what is my stockholders' equity, okay? Now, the first thing you need to ask yourself is, well, what constitutes stockholders' equity? And stockholders' equity is constituted of what? Common stock and retained earnings, right? Haven't we said that? Common stockholders' equity is common stock and retained earnings, at least for right now. And they give me common stock. So that's a piece of cake. Thank you, God. I'm going to write that 40,000 down. I know that's got to be part of the answer. So now I just got to figure out, well, what's the retained earnings? Now what happens? They don't tell me the 12/31 retained earnings. So I'm going to have to figure that out. Okay. I'm going to take the common stock at 12/31 plus the 12/31 retained earnings. That's stockholders' equity. But since they don't tell me the 12/31 retained earnings, I'm going to need to be able to figure that out. So my retained earnings is what? My retained earnings is the beginning balance. That says beginning balance right there of 30,000, because in a year's time, January 1st is the beginning of the year and 12/31 is the end of the year, isn't it? Okay, so I started out with 30,000. I then would do what? I then would go ahead and calculate my net income, and I calculate my net income on my income statement. Why do they call it the income statement? Because it shows the net income. So revenue of 125 minus expenses of 125 is my net income, revenue minus expenses. So I go ahead and I take my net income, add that to my retained earnings, and then my dividend is what? My dividend, they tell me, is 10,000. So when I do the math on that, that gives me ending balance of retained earnings of 65 plus the 40,000 for my common stock that the problem gave me. That means that the ending balance of my stockholders' equity is 105. Question? Keys to answering that question was what? Knowing what constitutes stockholders' equity, common stock and retained earnings, and then knowing how to calculate retained earnings when you consider what? Beginning balance plus net income, knowing that net income is revenue minus expenses minus what? Minus the dividend, knowing that that comes out of retained earnings, give you the ending balance retained earnings. And add those two together. Question.
The $101,000 there below the 45,000. What is that? I've got my net income at 45,000.
That's a $10,000 subtraction. That's the world's biggest comma.
Oh, that's the biggest comma. Okay.
I don't know if that helps.
All right.
I'm gonna erase it because it's permanently embedded in that slide. It's supposed to be 10,000. It's this dividend right here.
Oh, that's the dividends. Okay.
Right. Yeah, it's supposed to be 10,000.
So when you were figuring out you first figure out your net income, and then your dividend would be subtracted later. It's not that you would just go revenue minus expense minus the dividends would give you your net income.
Don't you dare do that.
Oh, I did do that. Okay, I gotta stop doing that.
It would give you the same answer, but it's very important, guys. Hear me now, everybody. It's very important that we realize that dividend is not reported on the income statement. Income statement reports net income. How do I calculate net income? Revenue minus expenses. So what's on the income statement? Net income. How do you calculate net income? Revenue minus expenses. Dividends get subtracted right off of the statement of retained earnings. They're coming right out of retained earnings. They are the plug being pulled out of the piggy bank's butt to take the cash out, right?
Got it. Okay.
So
that's why it's
through
that way.
here, guys.
Oh.
The net income goes in the piggy bank's mouth. The dividend comes out its butt. Okay, but it doesn't run through the income statement. So the income statement is where we make the pig's dinner. We feed the pig net income, and then it poops out the dividend, okay, when we're ready to take stuff out of the piggy bank. And I'll stop with that analogy.
Okay.
Okay.
No, it's actually a perfect analogy for me tonight. I'm having to drink all my stuff for my procedure tomorrow. So.
Okay. Well, enjoy that.
Gonna be a lot of dividends.
Yeah.
Well, if it's what I'm thinking it is, there's nothing to it. If it's the basic thing screening that we all go through at some point. So don't be nervous. Okay, guys, we'll stop right there for chapter 1. And we'll take a quick break here. What time does this class get out? 8 o'clock. 10 o'clock, right? So we've got plenty of time here. So why don't we go ahead? I'll tell you what, let's do, you want to do 10 minutes? We'll do 10 minutes and maybe we'll get out a little early. How about that? Is that okay? So we'll come back at 8:20 and then we'll go ahead and see if we can do some damage to chapter 2. Okay? All right, guys, we'll see you in a little while. Okay, guys, let's go ahead. Hope you had a good break. Let's go ahead and jump ourselves into chapter 2. Okay, so probably should label that a little better. We are now in our chapter 2 slides. Okay, and even though in our previous slides we had some important things about the different accounts, etc., to a large extent, our true understanding of accounting begins now. Okay, and that we're going to be focusing on something called double entry bookkeeping, double entry accounting system. Okay, and that means that debits will always equal credits. If we enter a transaction into the financial statements and that transaction doesn't have a dollar amount in which the debit dollar amount equals the credit dollar amount, we made a mistake. Debits must always equal credits. And that's the case throughout the world. And this system that we're going to be practicing with tonight has been around, as I mentioned a little while ago, been around since the 12th century. And probably before then, they just didn't write about it before then, but it's been around forever. And the system's still in use today. And I had a student one time when I was explaining something about debits and credits, and she said, oh, so if it's not fixed, if it's not broke, don't fix it. I'm like, not only is it not broke, it's thriving. Okay, all of these financial markets that we're always paying attention to thrive, function off of this system and these numbers. Okay, so it's a easy to use system. It's an effective system, and so it's just going to take us a little time to get used to it. Okay, so let's just come over and let's look at this. And guys, this is probably a little harsh. Okay, I know you're going to pass this class. All right, so don't take that personally, but it is also true. There is no way to be successful in an introductory to financial accounting class without knowing this. Okay, so you can see here that if I want to increase an asset, I debit it. If I want to decrease an asset, I credit it. Okay. If I want to increase a liability, I credit it. If I want to decrease it, I debit it. If I want to increase my equity account, I'll credit it. If I want to decrease it, I'll debit it. If I want to increase revenue, I credit it. If I want to decrease it, I debit it. If I want to increase my expense, I will debit it. If I want to decrease it, I will credit it. And even though this slide is not showing you specific parts of stockholders' equity, our common stock and our retained earnings work in the same way that you see here for stockholders' equity. Now, when we go through this, and you're going to have to just have this memorized, but let's just think about an example here. Okay, let's see if I can find I guess I can use the whiteboard here. Let's see if I can get out of this and use the whiteboard. It's a good place to do this. Okay. So let's say I have a situation where I provide a service for cash. Okay. What is this? Okay, so let's say I go ahead, I provide a service for cash. Should my revenue increase or decrease?
What's the question again? Sorry.
Let's say I provide a service for cash. Should my revenue increase or decrease?
Increase?
Increase.
Good, my revenue is going to increase, right? So my revenue will increase $100, right? Okay. How about my cash? Increase or decrease?
Increase?
My cash will also increase. Good. For $100. Okay. Now, what's happening? I'm saying that to increase an asset, and I don't want to go back to that previous slide because then I'm going to have to get out of this. So just try to remember. I said to increase an asset, I should debit it or credit it?
Debit.
Yeah.
Debit. So in effect, instead of saying add cash or plus cash, I said debit cash, didn't I? And my revenue has increased. And to increase the revenue, you're supposed to do what?
Credit.
I'm supposed to credit revenue. Okay, good. So look at what I've done. To record this transaction of revenue for cash, I have increased my cash. I have increased my revenue by what? Debiting cash, crediting revenue. My debits equal my credits. And if this was the only transaction that happened for this year, then I would have what? Cash of 100. I would have revenue of 100. My expenses would be 0 if this was the only transaction that happened. So my net income would be what? 100. And when I do my stockholders equity would be what? Would be liabilities of 0. My retained earnings would be how much? Beginning balance. I'll just do that over here. Beginning balance, assuming this was the beginning of the company, was 0. Net income is how much? 100. Dividends were 0. So my retained earnings is how much? 100. Does the balance sheet balance? Does the balance sheet balance? Yes, it does. So by using this system of making sure that debits equal credits and adhering to the rules to how they affect my assets, we didn't have any liabilities, but my revenues, we didn't have any expenses. By following those rules, I keep the balance sheet in balance by making sure that debits equal credits. Now, let's say that I have some expenses. So I'm going to pay $25 of expenses in cash. So my cash is going to increase or decrease?
Decrease.
Decrease?
Decrease, what I say, $25? Okay, which will mean it's going to have 75 left. In other words, I'm going to do what? I'm going to decrease cash by crediting it. And then let's say my expenses have gone up 25, haven't they? So since my expenses have gone up, they've increased. I'll put an up sign here. Since my expenses have gone up 25, my revenue minus my expenses will equal what? Will equal $75 of net income, okay? And to increase expenses, what did that slide say to increase expenses?
Debit.
Good. To increase expenses, I debit. So my debit of 25 equals my what? Equals my credit of 25, right? Those are both 25. Debits equal credits here, right? The debit equals the credit. And now what happens? Now my expenses are 25. My net income is 75. So my retained earnings is what? 75. My retained earnings is 75. And my cash is now how much? 75. And the balance sheet still balances, doesn't it? So as you record each transaction, as long as you follow those rules of those arrows that we looked at, the blue and red arrows, debits, credits, how to increase assets, how to increase liabilities, you keep those debits and credits equal, your balance sheet will always end up balancing, and allows us to record numerous transactions over the course of the year using this system, and allows us to generate the financial statements, our income statement here, our balance sheet over here. We were able to do it by following that system of debits and credits. Okay, so you take a look and you use this system. And like I said, I had a student say, well, why don't you just say subtract and minus? Because it doesn't work that way, because we're trying to keep the equation in balance. So you need this system that says that what? If I want to increase an asset, I debit it, like my cash. If I want to decrease an asset, I credit it. I want to increase a liability, I credit it. I want to decrease it, I debit. I want to increase my revenue, I credit it. I want to decrease it, I debit it. I want to increase my expenses, I debit them. I want to decrease them, I credit them. I want to increase my stockholders' equity, I credit it. I want to decrease it, I debit it. And although we haven't called out the elements of stockholders' equity, when you think stockholders' equity, you should be thinking what? You should be thinking common stock and retained earnings. Question. Okay, good. Let's go through this together then, okay? To increase an asset, you should?
Debit.
Good. Oops. Good. Debit it. Good. To decrease it, you?
Credit.
Credit.
Credit it. Good. Oh, well, let's do it. The way order they go in. I'll put it up after. To increase an asset, you do what?
Debit.
Debit. To decrease it, you?
Credit.
Credit. To increase a liability, you?
Credit.
Credit.
Credit. To decrease it, you?
Debit.
Debit.
Good. To increase a equity account, you? An equity account?
Credit.
Credit.
Credit. To decrease?
Debit.
Debit.
Good. To increase revenue, you?
Credit.
Credit.
To decrease it, you?
Debit.
To increase
So,
expense, I
Debit.
debit. To decrease it, I credit it. Good. Okay. All right, guys. You've got to sleep things. There's another way to get through this without doing it. It's like that reflex. So next time, if you're ever on a bus, maintain social distance from people and yell across the bus aisles to them, hey, to increase an asset, you debit it. To decrease, you credit it. To increase a liability, you credit. To decrease it, you debit it. To increase a stockholders' equity, you credit. To decrease it, you debit it. To increase revenue, you credit it. To decrease it, you debit it. To increase expense, you debit it. To decrease, you credit it. To increase your stockholders' equity, did I say that already? You credit it. To decrease it, you debit it. Okay? That's it. You got to know it just like that. Okay? And the more you practice with this, the better you know it, the easier this stuff gets. Sometimes students ask me, how do you memorize that? I'm like, memorize it? It will never leave me. Now I'm stuck with this for the rest of my life. Okay? Question. Okay, good. Now you also have to know this chart of accounts. Okay, because it does you know good how to know how to increase, decrease assets, liabilities, revenues using debits and credits, unless you know which accounts are assets, which are liabilities, etc. Right? So this is a pretty easy thing to remember. And let me start out. I don't know why some of these are red, so don't ask me. I'm not sure why some are red. I can't remember what they were trying to point out to us when they made some of them red here. So don't worry about that, okay? The color here doesn't matter, okay? But this is a chart of accounts, and notice we have our assets. The assets are all, and this is typical for a chart of accounts, that they're all in the 100s, okay? So cash is an asset, your favorite. Assets have future economic benefit. Accounts receivable will soon be cash. Supplies is a asset. You remember the paper supplies in the example we looked at, right? Equipment is obviously an asset. I have equipment I can use. Now, sometimes my students have trouble knowing that prepaid items are an asset. If you prepay something, this is the most obvious example of an asset in the world. I prepaid for a month's worth of service, for a year's worth of service. Well, that obviously has what? Future economic benefits. So it is an asset. In this example, prepaid insurance. So when you prepay something, that is considered an asset. Okay. Our liabilities are pretty easy. Notes pay a bill. Accounts pay a bill. Okay. Salaries pay a bill. Interest payable. Now, sometimes, and notice they're all in the 200s. Now, sometimes students have a little bit of trouble with this one, unearned service revenue. Okay. Now, unearned service revenue says that somebody has paid me in advance of me actually performing the service for them. It can happen. Somebody says, hey, John, I want you to, mow my lawn for the next year, and here's the whole year in advance. I'm not going to tell the person no. I take their money. Now, what happens? If I don't mow their lawn, what am I going to have to do? They gave me the money to mow their lawn. I take the money. Then I
hire somebody to do it or pay them back.
I'm going to have to give them the money back. We see it on Judge Judy all the time. Judge Judy sits there and says, well, you can't take the person's money and then not provide the service. You give him his money back, right? So you got to give that money back. Well, if I've got to pay money back to somebody, isn't that a liability? So until I have what? Perform that service, unearned revenue is seen as a liability because I haven't done the work yet. Now, we were being asked earlier, well, how would I analyze these accounts? Unearned service revenue is an interesting liability account, and that companies would look at this as a favorable liability if they see it going up year after year. What does that mean? Or staying constant even year after year. What does that mean? If you look at a company and their unearned revenue is 10,000 this year, 15,000 last year, 15,000 the year after that, 18,000 the year after that, what is that telling you about that company?
They have a backlog of demand.
Right? They've got business consistently booked into the next year, right? So an analyst might look at unearned revenue as actually a good liability, right? Whereas other liabilities, you might be a little concerned if they're getting too out of whack, right? Okay. Stockholders equity, we have already said is what? Common stock and retained earnings. And all they did here, guys, was they put the accounts that affect my retained earnings under stockholders equity. So what does income do to my retained earnings? Increases it. What do dividends do to my retained earnings? Decrease it, the piggy bank, okay? So they put dividends and income under retained earnings here under stockholders equity because it affects my retained earnings. Revenues are easy. They've got the word revenue on them. Expenses are easy in that they have the word what? Expense on them. Okay. So you have to know these two slides together. You've got to know this red, I call it the red and blue arrow slide, how to increase, decrease assets, liabilities, etc. You've got to know which accounts are assets, which ones are liabilities, etc. Okay. Question? Okay, good. This one is good in that it sits here and tells us all of the accounts, showing us debits increase, credits decrease, etc. for all the accounts. And then it does a better job, I think, of showing, well, it shows us revenues, expenses. It calls out the specific stockholders equity accounts. And something we really hadn't seen previously, dividends work the same way as expenses, don't they? Okay. Why? Because they both have the same ultimate impact on retained earnings. The only difference is what? Expenses are reported on the income statement in the calculation of net income, whereas dividends get reported where? Directly on the statement of retained earnings as we pull that money out of the piggy bank. But they both have the same effect in that what? As my expenses go up, my retained earnings come down. As my dividends go up, my retained earnings come down. So they have the same effect on retained earnings. So dividends and expenses do what? They move the same. To increase them, you debit them. To decrease them, you credit them. Question? Okay, good. So this is what we're going to be doing now. And remember, at the end of chapter 1, we had that exercise with, Ray and Barbara Neal and Soft Bite and all that. And we saw the transaction pop up there. And I said, hey, you got to know how to react to the transaction. I don't know if you need a magnifying glass like this guy has, but you got to be able to read the transaction and know what to do. Now, you will enter the transactions in a journal. First, you enter them in a journal, and then you post to the ledger. Okay, so there'll be 2 steps. Enter the transaction in the journal, post to the ledger. Okay, now we're going to go through this in-class example. I don't know why I'm taking it out of tablet mode, because I think I'm going to have to put it back in. I don't know why I took it out of tablet mode, because I'm going to have to put it back in. But we have this example that you see the slide that's embedded here. Okay, but what I'm going to do is actually walk you through this Excel spreadsheet that is in chapter 2 on the learning management system. In there you see chapter 2. Under chapter 2 you see in-class example, and there's 2 years worth of information. There's year 1 and there's year 2. Okay, now I probably should have told you, I'm going to give you a couple minutes. I forgot to tell you to print this out. Well, don't worry about printing it out now if you don't have it. You probably don't. I'm going to be writing some things later, though, that I'm going to want you to write down somewhere. So maybe you're going to want to get a separate piece of paper that you can write some things down that I'm going to be writing right on the face of this thing. And I apologize. I should have told you to print this out ahead of time, but I forgot. Okay. So, if you're watching this on the video, stop and go and print the thing that's under chapter 2. It's called the year 1, year 2 example. Okay. But let's just go through this. And we're going to go through a series of transactions for 2 years worth of this company. We're starting this company in year 1, and we're just going to see how we will first enter in the journal. Is it really going to do this? Let's see. Let's try it this way. Okay, so first we'll enter transaction in the journal. And then we will post to the ledger. Okay, So we'll enter transaction in the journal, we'll post to the ledger. Now this is somewhat of a tedious example. This is the only time that we will have to do something this tedious. What I'm going to expect you to know in the future is what do you debit and credit when you see a transaction, and then how does it affect the account balances, okay? But we're gonna go through this tedious example together so that you have in the back of your mind, this is the way the whole process comes together, okay? So issue common stock for cash, $1 million to start the company. So this is the very beginning. So I put some cash into the company and I issue myself common stock. So my cash has to increase, my common stock account has to increase, okay? So I debit the cash, I credit the common stock. Now, how do I know that I debited the cash and I credited the common stock there? Because it just says cash and it says common stock. How do I know that I debited cash and I credited common stock? I know I wanted to increase my cash. I know I wanted to increase my common stock. How do I know that I just increased them, debit and credit? I debited the cash, I credited the common stock, but how do I know that this was a debit and a credit right there? Okay, answer is debit on the left, credit on the right. Debit on the left, credit on the right. See how that debit of $1 million is indented to the left? See how that credit to common stock is whatever, tabbed out to the right? Debit on the left, credit on the right. Okay, so I debited cash by indenting it to the left. I credited the common stock by tabbing it, whatever, indenting it to the right. Okay, so I enter the transaction in the journal. Now I'm going to post. So I post that debit on the left, credit on the right. There's my debit. I post that debit to cash. I have to also post that credit to common stock. There's my stockholders equity, right? There's my common stock. I credit the common stock. Debit on the left, credit on the right. I enter the transaction in the journal. I post to the ledger. Now, don't write this down yet because we're going to write all this down here in a minute. So don't write it down yet, okay? But now I can sit there and I can immediately prepare that balance sheet if I wanted to. Don't do it yet because I'm going to prepare a whole balance sheet after we've gone through this entire year's worth of transactions. But my cash, well, do I have any assets? This thing's going to mess with me today. I can see that. Do I have any assets? Why won't it let me write? Damn it. Do I have any assets?
Yeah.
I have what?
Looks like you got cash.
I got cash so far. Now, these other transaction guys haven't happened yet. You got to use your imagination a little bit because I can't sit here and post each of these transactions as we go along. We'll be here forever, right? But I have this cash asset. Good. Do I have any liabilities at this point? Just after having made this transaction, okay, a couple of things. If you're in a mode where you're kind of like been watching TV while we've been going through all this, you need to stop that now. Because there's no way to understand this example without focusing. Accounting is a concentrating, focusing person's game. So you got to focus on what you're doing and just watch this example carefully, okay? This is going to set the foundation for everything we're going to do. So at this point, if this is the only transaction I've recorded so far, do I have any liabilities? If this is the only transaction I've recorded so far, do I have any liabilities?
No.
No.
No, so my liabilities are 0. Good. Then I come over and I look at my stockholders equity, my stockholders equity is common stock and retained earnings, isn't it? At this point, I don't have any retained earnings because I haven't had any dividends. I haven't had any income, right? But I do have what?
Stock.
Stock of a
Common
million.
stock.
Good. So I go ahead. I don't know why this thing is doing this today. I have common stock of $1 million. I can't stop it from wanting to bring the, that's annoying. I have the common stock of $1 million. Stay patient, John. Don't say it, John. Don't say the words that are in your mind. I don't know why it's doing this, guys. I generally don't have this problem, but this is gonna screw things up. It's what, $1 million is the common stock. Does the balance sheet balance?
Yep.
Balance sheet balances, and it balances what? No rabbits jumped out of hats. There's no magic going on here. The balance sheet balances because I simply went ahead here and did what? Adhered to debits and equaling credits, adhere to the rules of how do you increase assets. In this example, assets and stockholders' equity were the only accounts involved. Okay, so notice you had to look at a transaction. You had to know what account to increase cash, increase stockholders' equity. You had to know how to debit it, how to credit it. And then it's a mechanical process in which you pick up that debit from the journal, you post it to the ledger. Once you sit there and you pick up those, and it's a mechanical process to pick up cash, boom, put it in the debit column, balance comes up to $1 million. Then what? Common stock, take that credit, boom, post it to the common stock account. And when I do that, the what? Balance comes up to $1 million. And then the easiest thing here is preparing the financial statement. You just look at what's in your ledgers and you pull the numbers off of your ledgers into your financial statement. We've got our first balance sheet. Okay. Question. I'm going to erase this because we're going to fill this whole thing out.
Is the red color indicative of anything other than like a new entry?
Reds on this thing, reds are debits. Blacks are debits and reds are credits.
Okay. Is that a normal convention?
It's old-fashioned. It's normal and it's old-fashioned, but it's not standard. It's not standardized. But it's certainly worth something in terms of the teaching here. I guess. I don't know. I don't know how to answer that question. The answer is, I guess, no. It's not. What did you ask me? Is it normal?
I asked if it was a standard convention. And I guess kind of yes, kind of no.
There's no standard that says you have to do it. You could do it this way. There's a lot of companies that would show credits this way. I don't know how to answer that.
I understand. Thanks.
Yeah. Okay. All right, good. Now you come over and I guess let's say we're some sort of DJ outfit. Okay, we're a DJ company. We're DJ Pizzazz. So our business is that we're gonna go around and we're gonna be the DJ for parties. And in some cases, we'll go to the party and DJ. Other times, we'll invite the party to our facility. Okay, so that'll be our business. We're the DJ. We host parties, or we provide the DJing for parties. In some cases, we go to the party. Other cases, the party comes to our building. So we find a building that is perfect for our DJ partying business, whatever. And we find that building and the guy wants 1.2 million for it. So we say, hey, look, give it to us for $1 million, man. Come on. He says, no. 1.2 million, I'm firm on my price. So we say, well, look, all we have is $1 million cash. Will you go ahead and will you please take the cash, let us take over the building, and we'll owe you the $200,000. We'll have a mortgage pay a bill, okay? And the guy says, okay, fine. Hey, if you're gonna come in with $1 million cash, it's sold to you. Now, what happens? If the building burns down, who suffers the loss? Me or the guy that I bought it from?
You.
You.
Yeah, I suffer the loss if that building burns down. So I'm taking what? All the risks and rewards associated with that building. When I'm buying that building like that, I'm taking over the ownership of that building. I have the what? Future economic benefit of that building. So that building is an asset to me. The entire value of that building, what I am paying for it, the 1.2 million. So I go ahead, and since I'm taking over that whole building, I debit building. I'm taking all the, future economic benefit of that building. It's an asset. I debit it to increase it. I go ahead and I post my debit over here. I post my debit over here. Okay. And I'm giving him what? I'm giving him my cash. So I have to credit the cash to decrease the cash. When I decrease the cash, notice how these ledgers work. Now that what? That balances out to zero. Okay. It was up on the debit side. I just credited it. So now it's back level to zero, right? Okay. When I post those, I enter the transaction in the journal. I post to the ledger. And then I credit the liability because now I have that liability, don't I? I credit liability mortgage pay a bill. I credit that liability. That increases the liability to 200,000 when I post that over. Okay. Now, when I prepare my financial statement, when I prepare my balance sheet, I'm going to have assets. Assets. Do I have any assets? Do I have any more cash? How much is my cash now?
Zero.
Zero. But now I have what?
Building.
A building.
Building. Good. Don't write this down yet, guys, because we're going to put this whole thing together here. I just want to show you right now how this transaction affects my balance sheet. So I have building of 1.2 million. But now what? Now I've got this mortgage payable. So I have a liability, don't I? The mortgage, I'm abbreviating that, payable of what?
200.
200,000? Dang it, why did it start doing this? So irritating. 200,000? Okay, and my common stock is still sitting there, isn't it? The common stock of 1 million, that's still there. So my common stock now is what? Still 1 million. Does the balance sheet balance?
Yes.
Assets equal liabilities plus stockholders equity. Good. Okay, that's my stockholders equity right there. I should probably squeeze that in. Stockholders equity, my common stock is 1 million, and the balance sheet still balances. Okay, so when you do this, you pay attention to your debits and credits, make sure they balance, right? And then you increase your assets and liabilities accordingly, following the rules. It keeps the balance sheet in balance, right? Okay. Okay, good. Let's do another one. Okay, let's go ahead and let's do this purchase of this vehicle now, Because remember, we said that we are going to sometimes go and take our equipment to the party. So we need a vehicle. So we go to the, we want to get one of those. I don't know if you've ever seen like those kind of fancy limo type vans. We want one of those, right? So we go to the fancy limo van dealer and we say, yeah, we'd like one of these vans. This black one is perfect, and the guy says, well, okay, it cost $150,000. And I say, well, I don't have any money. And so he says, okay, well, let me run a credit check on you. And he sees that my credit is good. They let me drive a vehicle off the showroom floor with no money? Will that ever happen to you?
No.
Yes, it will.
Well,
Yes.
Yes. Are you kidding? All this studying, getting an MBA and everything, do you think if LeBron James walks in to the limo dealer or the car dealership and they say, oh, sorry, Mr. James, if you don't have any cash today, we ain't going to sell it to you? They say, pick the ones you want, Mr. James. We know you got good credit. You can take two. Okay. So what happens? That'll happen to you. You'll walk in with your, good credit and your, ability to generate income. They'll sell you two vehicles if you want. Let you drive them both off. You can have one leg in one car and one in the other. They don't care as long as you pay them, right? Okay. So what happens? We get the equipment. The guy says, no problem. He checks our credit. Does this limo van have future economic benefit? It does.
Yes.
It's an asset. So we go ahead and we what? We
Credit. Debit.
What?
Debit.
It's an asset. We debit it to increase it, right? Hello? To increase an asset, you debit it, right?
Yes.
Right.
There's that debit. Okay. And then, but now we have this vehicle payment payable. We've got a new bill, don't we? So to increase the liability, you credit it. Debits always equal credits. We post that credit over here. So now not only do we have the vehicle, but now we also have a liability. That's the sad part of buying a new car. I got a nice new car, and then now I got a liability I got to pay, right? So you've got the future economic benefit, the rights and rewards and risks of ownership. What happens if you buy a new vehicle like this, you drive out of the parking lot and you hit a pole? As you're driving out of the parking lot, you scrape against a pole. What's the car dealer going to say to you? Is the car dealer going to say to you, look what you did to my car? Or is the car dealer going to say, look what you did to your car?
Your car.
Your car. It's your car. You have all the risks and rewards of ownership. So you record that asset, showing your ownership of it. But what? You also have to show that you owe on this thing now the liability, right? Debit equal credit?
Yeah.
Okay. So now why is it doing this? There must be a way of stopping it from doing this the way it's doing it. But anyway, so now I have what? Now I have vehicle. The vehicle, the delivery van, whatever, the limo van is 150,000. Now my liabilities, guys, I'm just going to combine them, is what? Is the vehicle and the mortgage. So my liabilities are what? 350? I'm just writing. I'm just adding them both together. The what? This one and this one. Okay. You add those together. Those are both liabilities. Those are both bills. My liabilities are 350. My stockholders equity is still 1 million. Nothing's changed there. So does the balance sheet still balance?
yes.
Still balances. Okay. Good. So what happens? Debits equal credits. To increase assets, you debit them. To decrease them, you credit them. To increase liability, you credit them. To decrease them, you debit them. I follow those rules. I do the mechanical process. Enter the transactions in the journal as they happen chronologically, and then do what? Post them to the ledger. Then whatever the what? Whatever the ledger accounts are showing as the balance, whatever the ledger accounts is showing as the balance, okay, I go ahead and I do what? I post that to the financial statement. Preparing the financial statement is the easiest part of this whole thing, because I simply look to see whatever the balance is in the ledger accounts and then write them down in the form of the financial statement. Income statement, statement of retained earnings, balance sheet. Okay, now I'm going to stop this sort of intermediate preparing of the financial statements. I'm going to go ahead now and record a series of transactions. We're going to enter them in the journal following the rules of debits and credits, and then we're going to post them to the ledger, and then we're going to prepare the financial statements. Okay, so I go ahead and I do my first concert here, my first party, whatever. I DJ my first party, and it's one of those where I go to their place and do the party, right? And so the guy says, hey, nice job. You know, we contracted ahead of him how much it was going to be, and he pays me cash $200,000. Okay, so what happens? I'm going to debit the cash, 200,000, to increase it. If someone hands you cash, does your cash increase? Yeah, so he goes ahead, he hands me the cash, right? And when he hands me the cash, I go ahead, I debit the cash right there. And then I'm going to post that over to my cash account. I'm liking that better. I didn't like that zero cash, so I've got now 200,000 cash. Mechanical process, the posting, take the debit to the cash, post it to the ledger account comes up, this 200,000, right? To increase the revenue, you credit it, don't you? So I go, what?
Did you say asset?
No, I said revenue.
Oh, sorry. Yeah.
Credit.
To increase the revenue, I do what? I credit it.
Credit.
So I go ahead and I credit the revenue. And when I do, here it is, I post it over here. The revenue account comes up 200,000, right? Debit equals credit. Okay. Now remember, this was one of those where I went over and, you know, did the party at their place. And so I have to hire these, you know, lift people. They're going to come and lift all my equipment and take it, you know, and put it in the truck. We drive over to the party place. They take all the equipment out, set it up. They take all the equipment out of the place. They put it back into the truck. And then they take it out of the truck and back and store it back at my place, right? So at the end of the night, they're pretty big, pretty muscular, you know, and they come and they say, hey, you know, we want 70,000 for that work we just did. So I'm like, okay, don't kill me. So what do? I reach in my pocket and I take 70,000 cash and I hand it to them. If you reach out of your pocket and hand cash to somebody, your cash does what? It decreases. So I go ahead and I'm going to credit my cash. I credit my cash right there. I credit my cash. I post that over. And when I post it, my cash comes down, the balance comes down to 130, right? That's how much cash I have left in my pocket. And I debit expense. There is no more future economic benefit associated with the work those guys did for me. They what? They moved the equipment, they brought it back, they drive away and went by. I'm thinking, yeah, those were some rough characters. Maybe I'll never see them again. Any future economic benefit has expired, right? So to increase my expense, I debit it. And when I when I debit my expense, when I debit it, that increases it. So now my expenses are showing what? 70,000. Okay. I know there's other transactions posted there yet, but theoretically those haven't happened yet. Okay. Okay, good. Now what? Now I have $130,000 sitting in my cash account, but that's sitting in the corporate account. So even though my corporate name is DJ Pizzazz, my real name is Irving. And Irving says, Irving's just a very, kind of shy guy. And Irving says, I'd like some waffles for breakfast. So he goes and he pulls some money out of DJ Pizzazz's account, right? His corporate name is DJ Pizzazz, but the real guy is a very gentle guy named Irving, right? So what happens? Irving goes and pulls $13,000 out of the cash accounts. He takes a dividend. Okay. Now, when he's pulling that money out, he's pulling it out of the corporate account. So he's going to have to credit cash. Okay. So we credit the cash. When you credit the cash at 13,000, now it comes down to this 117 and debit dividend. Remember, we saw on the slide to increase a dividend, you debit it, right? Because we're now showing that we pulled a dividend out. And we're going to report that dividend where? Not on the income statement. We're going to report it on the statement of retained earnings. And we're going to see how that's going to look here in a minute. But I'm going to go ahead and I'm now going to debit dividend 13,000. And now I'm showing that I've paid $13,000 of dividend this year. Okay. Okay, good. Now, I'm going to have a series of transactions here that we're going to look at in a couple of minutes, and we're going to call those closing entries. But before I do my closing entry, now I'm ready to prepare my financial statements. Okay. And when I prepare my financial statements, I go in a certain order. So first, I'm going to prepare my income statement. Isn't this exciting? I've had these business transactions. I followed the rules of debits and credits. I entered them into the journal. I posted them to the ledger. And now I'm going to be able to use the ledger account balances to prepare my financial statements. I mean, this is it. This is what this whole class is about. Can you do this? Can you see a series of transactions that happen for a company, and can you turn it into a set of financial statements? And we're about to do that, okay? So I come over, and what is reported on the income statement? What is reported on the income statement?
Income.
Net income. Good.
Net income.
How do I calculate net income? Revenue.
Revenue minus expenses.
Good. So let's see if I can figure out what my revenue is. Let's see if I can figure out what my expenses are. And when I do the difference between my revenue and expense, I should be able to get my net income, right? So do I have any revenue? And I come over and I look at my ledger account, and right now my revenue is how much?
200,000.
200,000. Good. Put that in. Do I have any expenses? That's showing up at 70. Revenue minus expenses equals what? Net income. Net income is how much? 130,000. Isn't this exciting? You made your first income, or your first financial statement right there, this income statement. Revenue minus expenses is net income. Good. Second statement is going to be statement of RE is retained earnings, guys. Statement of retained earnings. Statement of retained earnings is my what?
Piggy bank.
There's my piggy bank, right? So my beginning balance, if this was my first year in operation, my beginning balance was how much?
0.
0, good. My net income comes down from my income statement, right? My net income was 130,000 less dividend. Did I pay any dividends?
13,000.
Yeah, right? DJ Pizzazz paid Irving 13,000, right? Means that my retained earnings ending balance is 117. Am I doing my math right?
Yes.
Okay. Okay, good. So I've got what? I've got my income statement. I've got my statement of retained earnings. Third now, third statement is my balance sheet. Incredible. Sure, if I change pens, maybe it'll stop this nonsense. No, it's getting worse. Sorry, guys. I don't have this problem. Any thoughts on how I can stop that? Third statement is my balance sheet. Okay, that says balance sheet, believe it or not. Okay, so do I have any assets? What do I put on my balance sheet? I put on my balance sheet assets, right? Liabilities and stockholders equity. Do I have any assets?
A building and car.
Well, is cash an asset?
Yes.
Yes.
Do I have any cash?
Yes.
Okay, remember, preparing the financial statements is the easiest part, guys. You simply look at what's in the ledger accounts and write them down in the form of financial statements, right? So I have cash of what, 117? I'm just pulling the numbers off of the ledgers. So my balance sheet, I have cash, 117. Then I have what? This equipment, 150,000. Any other assets? Building is an asset, right? Any other assets? That's it, right? Okay. So what's the total of my assets? Help me out, guys. Total assets. I'll wait.
1,467,000.
Okay. Do I have a second on that? And that doesn't mean I don't trust you. That's just how we do things in accounting. We verify.
Correct.
Like a,
1,467,000, you say?
Yeah.
Okay, good. Keep going. My balance sheet will have to balance my assets, will have to equal my liabilities plus my stockholders' equity, right? Do I have any liabilities? Do I have any liabilities?
The mortgage?
I've got the mortgage up there is what, 200,000? Notice, guys, I mean, the numbers are pretty easy for us to just kind of remember off the top of our heads, but you know, you don't walk around in your head with these numbers when you're preparing financial statements. You would look to see what's in the ledger, and I have mortgage payable 200 and vehicle payable 150, right? So I write those down. Good. Any other liabilities? No, doesn't look like it. So my total liability is 350,000, right? Even I can do that one in my head. And now I just need to get my stockholders' equity in here, don't I? Now, when I look at my stockholders' equity, guys, notice that what? I have my common stock of $1 million, don't I? Yeah. Okay. So there's that $1 million common stock. So I'm just going to go ahead. I'm going to write down common stock. $2 million. I mean, not 2 million. What is it? 1 million? Stop it. Of 1 million?
Yeah.
Assuming this stupid thing is going to let me write a 1 in here. Okay, so there's my common stock of 1 million. Okay, but now I've got to do what? I've got to bring in my retained earnings. Now, this is where this gets a little tricky, in that if I look at my retained earnings right now, notice, guys, up until now, right, we stopped our transactions right here. There was no debit or credit to retained earnings. These ones that I've highlighted, I haven't gone through these closing entries yet. I haven't made any entries to retain earnings. So I'm okay, though. I can still finish my balance sheet because I know that the ending balance of retained earnings is going to be how much? This 117. Because I said beginning balance was 0, net income, which I got from the income statement, was 130. The dividend I got from my ledger account was 13. So now my ending balance and retained earnings is 117. So I simply pull that 117 down to my balance sheet, 117,000. My total stockholders' equity is 1,117,000. And then I'm going to total my liabilities plus stockholders' equity. Help me out on this. 350 plus 1,117,000 is going to be how much?
1,467,000.
Good. Does the balance sheet balance?
Yes.
Did any rabbits jump out of any hats? The answer to that question is no.
No.
No rabbits jumped out of any hats. It was not magic. I simply did what? Look at that nonsense. I simply sat there and did what? I simply sat there and followed the rules of debits and credits. And by doing that, increasing my assets, decreasing my assets, increasing with debits, decreasing with credits, etc., the balance sheet balanced, right? Now, I have two objectives I'm going to try to accomplish now. by, don't walk up on me. Okay. I've got two objectives that I'm going to try to accomplish now by doing my closing entries. Closing entries have two objectives. One is to get that retained earnings balance to show 117. Right now it shows 0, but it's got to match. Every account balance has to match what's on my financial statement. You're saying, but John, you prepare the financial statements. Yeah, fine. But I've got to make sure that every ledger account matches what I'm showing on my financial statements. So I've got to get that retained earnings to show me 117. And important point here, guys, listen to me. I've got to turn my revenue account, my expense account, and my dividend account back to 0. I keep track of my income by year, don't I? So I need to turn those back to 0. So when I start year 2, everything should show what? Should show as not everything. My revenue, my expense, and my dividend account should show at 0. So my income statement accounts and my dividend account shows 0. Everything else, the ending balances will carry forward to year 2. Okay, so let's see how I'm going to do that. I'm going to close my revenue. So I want my revenue to be how much?
0.
0. When I finish the year, it needs to go back to 0. So since it had a $200,000 credit balance, to decrease it, I'm going to do what? I'm going to
Debit.
And when I debit it, 200,000, and you can see, let me do this in the correct order, John. Don't get impatient with yourself. I'm going to do what? I'm going to debit revenue. Debit the revenue. When I debit the revenue, and I post that over here, now this revenue account shows what? Forget it. Now this revenue account shows what? Shows 0. Is that what I wanted?
Yeah.
I entered that debit. I post that debit. Now it shows 0. Is that what I wanted?
Yeah.
Okay. Okay, good. So I go ahead and I debit the revenue account and I credit an account called income summary. Now, income summary is a place where, a temporary holding place where I will put my closing entries to basically eventually show my net income. So income summary is kind of a weird account because when I first credited, I debited the revenue. I did what? I credited the income summary. And when I did that, income summary is showing me for a second my revenue for the period, isn't it? But I want my expense account to be 0. So to get my expense account to be 0, I have to do what? Well, remember I debited them here. So now to what? Make them 0, I have to credit them, don't I? My expense account. So when I credit my expense for 70, and I post it over here now the expense turns to what? Turns to 0. Is that what I wanted? My expense is now 0. I debited income summary, right? Just posting them from over here from the journal. I post them to the ledger. And when I post that to the ledger, it's showing 130. How much was my net income? Right here. How much was my net income? How much was my net income? 130. It's showing 130, isn't it? Yeah. Okay. Okay, good. But my net income needs to go where? Where do you put the net income?
Income statement.
Well, it shows on the income statement, but where do you feed it?
Income summary.
It's
Statement
in
of retained earnings.
130 showing income summary right there. Huh? Is he hungry? Is the pig hungry? Is the pig hungry?
Always.
Hmm?
Always.
No.
Always. The pig is always hungry. The pig wants net income, doesn't he? So I got to feed the pig net income, right? In other words, I got to put
piggy bank.
I got to put it in the piggy bank. I've got to feed the pig. I put it in retained earnings. So what do? I'm going to take it out of income summary. So net income is kind of like sitting there trapped in income summary saying, help, help. I said, what's wrong? I want to go home. Well, where do you live? I live in retained earnings. Okay, well, I'm going to go ahead. Can you get me out of here? So what do? I debit income summary. And when I debit income summary, net income is out of there. Of course, I would debit it in the journal first and then post it. Now my income summary goes to 0 because I keep track of my income by year. That's good. It'll start the new year at 0. And then I go ahead and to increase a stockholders equity account, you credit it, don't you? And so when I credit retain earnings, and isn't that beautiful that it fed right into the pig's mouth? I didn't do that on purpose. But when it goes ahead and we feed the pig and it goes into retain earnings, I credit retain earnings 130,000. I generally don't have this problem, guys. I credit the retained earnings 130,000. And when I do, the balance goes to 130,000, right? Is my net income now sitting in my retained earnings? Is my net income now sitting in my retained earnings?
Yes.
Yes.
I got it sitting there, right? It's in my retained earnings. I did that by debiting income summary. That closed that out to 0. And I credited my retained earnings. Retained earnings has 130,000. My dividend comes straight out of retained earnings, doesn't it? So now to close the dividend account, because I debited it up here before, now I'm going to what? Credit it. When I credit dividend for 13,000 and I post that over here, now the dividend account shows 0. All right, there's that 0. It shows 0, which is what I want. I want my dividend account. I want my expense account, my revenue account. And now, as you can see, my income summary to all shows 0. So my dividend account shows 0 now. And I take my dividend straight out of retained earnings. So I debit retained earnings for what? That 13,000. And it would have to go up there just to make it confusing. Not that debit. Oh, screw you. I debit the retained earnings, not up there. I debit retained earnings where? Right here? Okay. I debit that retained earnings, 13,000. And when I debit retained earnings, 13,000, now the balance is what? 117,000. Does the 117,000 match what I showed on my balance sheet?
Yes.
So did I achieve the objective? The objective of the closing entries was to do what? Was to turn my revenue, my expense, my dividend, and income summary also has to go back to 0. okay, was to turn these back to zero, right? My revenue, my expense, my income summary is zero, my dividend is zero, and my what? I got those back to zero where I wanted them, and what? And now my retained earnings balance matches what I've shown on the balance sheet for my retained earnings. So we've got a perfect imbalanced general ledger. We've got what? Financial statements that we pulled from those ledgers. And all of that happened by doing what? By following this system of debits and credits. Increase asset, you debit them. Decrease them, you credit them. Liabilities increase, you credit them. Decrease, you debit them. You follow that system. You pull your financial statements. You've got your financials. You give your financials to your investors, to your external users, who's ever going to be using those. They now got your financial statements. You go through, you do your closing entries, and now you're ready to start year two. Okay. Now, when you start year two, very important. We're not going to do year two now because I think you're going to be a little tired for that. We'll start with year two next time. But notice something very important. Notice right out of the gate that what? The beginning balance for, man, this thing is driving me nuts. The beginning balance for my revenue, my expenses, my income summary, all start the year where?
Zero.
Dividend, everything, those accounts all start the year at zero, don't they? My revenue expense, my expense account, income summary, dividend all starts at zero because I keep track of them by year. My balance sheet, all of last year's ending balances roll forward to this year's beginning balance for my balance sheet accounts. There's the building, there's the vehicle, there's the cash that's sitting there, right? Okay, cash ending balance was 117. Equipment was 150. Building was 1.2 million, right? I start the new year with those things. So think of your balance sheet as your wallet. You go to sleep on New Year's Eve with $117,000 in your wallet. You get stiffed by your friends. You fall asleep at 9 o'clock. You don't wake up until the next morning, January 1st, until, 9, you sleep for 12 hours. You wake up 9 o'clock in the morning that next morning, January 1st. Is there still 117,000 in your wallet? You guys must have some shady friends. If
I hope so.
117 will still be in your wallet, huh? Is the 117 still in your wallet on January 1st?
Yes.
Good. Is your building still there? Is your house still there on January 1st?
Yeah.
Your
Hopefully.
is still there on January 1st. But you haven't earned any money yet in the new year, right? You got to go to work that first day to start to earn that money for that new year, right? So your assets, you still owe 120,000. You still have your retained earnings. Your retained earnings, now we have a beginning balance in retained earnings. My retained earnings now beginning balance is what? Is 117, because presumably I'm showing retained earnings is showing what's happened throughout the history of the company. Beginning balance starts at zero. By year two now, I had an ending balance, so my beginning balance starts at what? Starts at year one's ending balance, and that becomes my beginning balance, and so on. And then you start the new year making more money, generating some revenue, and we'll keep track of that for year two. Okay, and we'll do year two next time, but let me pause there. Any questions about any of this example right now?
I have a question. So this is posted to Canvas, but is it the format before all of the highlighting and the notes?
It's before the highlighting and the notes. So what I'm going to recommend you do, you don't need the highlighting, but you do need these financial statement numbers.
Mm-hmm.
So you're probably going to have to watch the video and put it to where, so you can write the numbers in.
Okay.
And that's not a bad exercise anyway.
Yeah, exactly. Okay, thank you.
Yeah. I should have told you to print it before and then you could have gone along. And I apologize. I don't know why I've had this where it doesn't fight me to draw on it. I don't know why it's doing that today. Question? Okay, let me say, I'm going to say this several times before we take our first midterm, but mastering this example is, if you master this example, I can't trip you up on any question on the exams. Okay, this pretty much covers almost everything we're going to talk about on the exam. Okay, so you want to get this example down, but we're going to go through year 2 next time. I'll talk to you more about working with this example as you prepare for your exam, okay? But this is a key example, key document for you. Okay, any other question? Alrighty, guys, I will post this up. Look for it, sometime early tomorrow morning while it processes, and I will see you next Tuesday. All right. Okay, guys. See ya. Have a good night.
Good night.
Thank you.
All right.
Thank you.
All right.
Thank you.
Thank you. Thank you.
Very
Have a
much.
good night.
Thank you.